Masterclass, a 10-part evergreen podcast series where Adam Butler, Mike Philbrick, and Rodrigo Gordillo of Resolve Asset Management Global explore an advanced investment framework specifically designed to steward quasi-permanent capital with humility and balance. From the science of decision-making to all-weather portfolio construction to the value of diversified alpha and tail protection, this series provides a comprehensive capital management roadmap to improve outcomes for wealthy individuals, advisors, family offices, and institutions managing less than $10 billion. To listen to the series or read the transcripts on demand, please visit investresolve.com/masterclass. Alternatively, you can find it on your favorite podcast player by searching for Resolve-Masterclass.
Welcome, Friday afternoon. Check out this lineup. We've got my man Rodrigo. We got Corey Hoffstein from Newfound, and co-hosting. And our guest this week is Chris Schindler from Castlefield. Chris has been on a couple of other times, but it's been a while, so we're looking forward to catching up. And obviously has been one of our more popular guests. So want to welcome everyone. And I didn't get a drink, but maybe we can all raise our glass to Friday afternoon. It's been an interesting week. You guys all raise your glasses.
You didn't get a drink. What's going on, Butler?
I don't know. I got to bring my best game here today.
I've ever heard that come out of your mouth.
I want to say I was sitting here looking at my drink thinking, this looks like a lot more liquor than I actually poured. It's just all the ice melted.
Lots of ice.
We'll take your word for it. Not that much. No judgment. I was like, wow, that's a lot of booze.
Reminder to everybody to we are live on YouTube. We're also live on Twitter. Ask questions if you're interested in hearing Chris's perspective. And then Corey, Adam, me. I don't know where you're at, Chris, with your social media, but we should retweet that we are live now on our Twitter stream.
Yep.
All right.
On LinkedIn, does that count?
It doesn't.
LinkedIn, no. Please God, come on. You're running a business, aren't you, in 2021?
Yeah.
Now that we can actually say that you are running an actual live strategy.
So you're saying I need Twitter now?
On LinkedIn.
All right. Yeah, okay.
It's a prerequisite. So speaking of you running a live strategy and having a live hedge fund, why don't you tell us a little bit about Castlefield and what you do over there?
Yeah, sure. So we are a relative value systematic macro shop, and it's very hard to put yourself in a box because you're a CTA. Oh no, we're not a CTA, but we're not. So there's always boxes everyone tries to put you in, but we kind of go relative value, systematic macro. We're trading futures, but we really like to think that we're creating a product that's distinctly different than anything else we've seen out there at the moment. So we think we're really trying to do something unique and different. We have about 21, I guess, at the moment, independent models that are all working together. All kind of betting on the same assets to try and create some sort of ensemble approach to trying to predict which way markets are going to go. Great team. Super excited about the team. We've been up and running for 6 weeks. So I'm very, very excited about how things are going. So I'm really happy to talk about what we're up to. But yeah, it's been a long road. So it's great to be here.
Chris,
we were chatting earlier about the. Yeah. Go ahead.
Interrupt. I was really curious. You said you just launched 6 weeks ago. When did you start the process of trying to get this launched?
Oh, well, I resigned from teachers in September of 2018. And so it's look, it's super easy to start a hedge fund. I suggest everyone try it at least once in their life. Yeah, but yeah, it's a tough road. And I think, I'm going to be facetious here. I think a private equity guy could probably leave, rent an office, set up a computer, do a web page, and maybe buy a fax machine. I'm not sure. And then they're good to go. It is systematic investing. It's there's a couple of years of, like I said, maybe at least a year of research. There's a lot of operation systems and architecture. There's a lot of work, but it's never dull. That's for sure. So.
We were talking in advance about the fact that it's often really hard for quants to tell their story, right? Maybe quants are not natural storytellers in general. More sort of classically left-brained than right-brained. Maybe traditional discretionary managers, you can tell stories about the stocks you like, and that gives it some insight into your process and your framework. With quants, it's a little bit more ephemeral. So I know you've actually given some thought to how you describe your origin story and the origin story for your strategy and how you think about it. So why don't you go for it, man? Let us hear it.
All right. Okay. I mean, there's a
hold on, Chris.
there's a long form version, so I warned you about this.
Before you do, I want to make sure we follow Mike's advice and make sure we let you know that whatever we talk about today is not advice. This is for entertainment and illustrative purposes only, and you should not act on this information in markets in any way. And with that, Chris, tell us your story.
Yeah, absolutely. And Adam, you're absolutely right. You know, I do think, like, when you hire a discretionary manager, you talk to them, you get to know them, you get to know their thought process because they describe their thought process in their investment thesis. And I think it's very natural. It resonates with a lot of investors. And I think it's really, really important for a manager to be able to tell a good story so that the investor understands how they think. And I think, like I said, in systematic investing, the story is way harder. It's way harder. And not only that, quants are not good storytellers. Like, everyone's been to that conference where some guy stands up with formulas on a PowerPoint slide talking unintelligibly. No one has a clue what he's talking about. And I find those really bad for the industry. So I really think that when you start to invest, you have to start with a story for yourself, right? You have to know what you're looking for, because there's lots of different types of stories. There's the what am I looking for story, which is like a thesis that you start with, and that's very important. There's also the story of what did I find. I'd say it's a less useful story because you can data mine, find some relationships, find some patterns, and then try and explain to yourself why that may have happened, which can be helpful but can also be dangerous. And then I think where the star discretionary investors are extremely good is the after the fact, here's why I did what I did story. And the really, really, really good ones are the ones who, even when they lose money, can convince you that they made the right trade. And so that's like that. And you're
hashtag global macro.
It's hard, right? It's so important that your investor understands your story, because they have to hire your thought process and you as people still. It doesn't matter who. Like if you're going to hire someone and bring them in house, you get to know them well. And when you hire a discretionary manager, you get to know them well. When you hire a systematic manager, I think some of the times you're just hiring a return stream or a marketing
deck. That's the perception.
And that's the perception as well, because I think a lot of times the allocators don't know systematic all that well, and so it's hard for them to dig into the thought process, and that's definitely a challenge. And so it's the onus is on the systematic guys to explain how they think in their thought process in a way that resonates. And so I tried really hard to think about different ways to do this.
How much of that is self-imposed by quants, though? I mean, I look back to post-2008, and over the last decade, quants have done nothing but say, look how great we are. When you buy a quant process, it's systematic, it's disciplined, it's not going to change. And we backed ourselves into a corner, because the reality is being a quant doesn't mean your process doesn't change. It just means the way that you view the world is through a quantitative lens. We would hope there's an evolution of process. But the entire smart beta ramp up was this philosophical push for consistency of process. And I think we did this to ourselves in a large way. I honestly think quants are very responsible for the current conundrum they're in.
I don't disagree at all. And there's a lot to unpack in what you just said there, because there are certain things where you can say, like, I understand why I have a defined thought process, and that thought process should have some stability to it. But the way you capture it, and even the different things you try and capture, like, you have to be constantly evolving. If you are standing still, you're falling behind. There's no doubt about it. And so your entire day to day, and if you don't love research and you don't love coming up with new ideas and you don't love building new stuff, it's not the right space for you, because you can't just settle in and lock down and sit back and go retire. But there are, I do understand that, does low vol or low minimum variance or quality or value, they can be done better and differently. I think some of those things have kind of unfortunately locked down a little bit. People can fiddle around at the margin, but the majority of that is probably kind of locked down. I think that's part of the problem as well for quant investing in general, is that when something gets locked down, it becomes commonplace and well known, it gets crowded, right? And if I have a story and if I have a thesis, and it's across the board, it's not just systematic investing, but crowding is the enemy. There's just no way around it. Whenever any trade gets too crowded, any idea gets too crowded, any position, any asset class gets too crowded, just by definition, its prices get bid up. For the same cash flows you're buying, the prices are higher, the cash flows are the same, your expected return becomes lower. Your risks go up as it gets crowded, your correlations rise as all sorts of people are trading the same sorts of things. And so crowding, it drives down risk-adjusted returns. It drives up correlations. It drives tail correlations. And then in systematic investing in alpha strategies, it's even worse, because the crowding is not just, it's not just like, hey, buy and hold, and you get what you get down the road. And if other people coming behind you, at least you benefit from that, because everyone is competing at the margin for the next trade. And so crowding gets attacked at the actual time of execution as well for those guys. And so it's a real challenge. And when I was trying to go back through this, and I'm going to repeat myself, because I was like, what did we talk about in that first podcast again? I was trying to remember, and I read through the transcript. Oh yeah, we talked about like almost everything. And so we covered a lot of stuff. And then in the second, conversation, when we really kind of dug into portfolio construction and betas and alt betas and putting the portfolio together, the CIO's challenge and the major factors, and the main takeaway being, it's going to be hard to be a CIO because everything is crowded. And I think it's very, very hard for people to look around in the world today and go, where is my value buy? There's some relative value, but where's my absolute value buy right now? Are equities cheap? Are bonds cheap? Is credit cheap? Is vol cheap? Is alpha looking like where's the undiscovered country? And there aren't many. And then we went, here's the other problem. Like, not to get too bearish for a second here, but not only is everything expensive, but your major sources of risk, which are always growth risk and inflation risk. We talked about this, in the last podcast. You go, and those risks, which were kind of the defining risks of the world for a very long time, because those risks sort of they dictated almost everything. And obviously there's lots of idiosyncratic things, but those are the major risks that kind of change everything. And in the last 10 to 15 years, we've had a new one show up on the scene, which is discount rate risk. Right, and discount rates are supposed to move with expectations of change in growth and change in change of inflation, and by discount rates I mean everything that connects the cash flows to the price, the IRR that connects those things. It's supposed to move with them. But if let's say a third party comes in and completely breaks the connection and to a certain extent distorts that signal, and discount rates are all driven towards zero, and the price of everything rises, you go. That becomes a very, very common source of risk at that point as well. And I would say the major driver right now in our marketplace is the occasional inflation scare, the occasional growth scare, but mostly what is the Fed going to do about those two things? Because that's actually the major source of risk is this third-party response to those two things, which is the major driver now. And the problem with that is every single asset class on the planet is the present value of future cash flows. Every asset shares that same source of risk. There is no stocks and bonds respond to growth and inflation differently. They both get hammered in a discount rate that rises unexpectedly. And so does the dollar. And so does everything goes. And so then some commodities are dragged into it. And emerging versus developed is dragged into it. And so you go, man, at the wrong time, and this is we're very late stage in this process, you start to reduce yourself from 2 or 3 factors to one dominant factor, and that becomes very scary. And stuff happens like yesterday. It's an interesting day for anyone who doesn't trade commodities. I think grains had their biggest down day since 2009 or something like that. These are these days that are very exciting.
Some of them had down days that were larger than any day since 1988. It was a very long time.
I've never seen every commodity go limit down. I mean, limit not quite, but it was quite something. And so that why do they all move together at the exact same time? It's it's this.
Except for energies.
Yeah.
Separate. Yes. Separate energies.
So we've got this dilemma, right? And it is a common dilemma. It's a dilemma that's common to every investor. And I think that was a big motivation for you to sort of start this group 10 years ago. And the problem has only become more acute since then, right? And so Castlefield is really designed to be orthogonal to, all of the major beta risks, along with a couple of other alternative risks, right? You try to hedge out kind of trend following as a factor, but you did a good job of sort of describing the meta story of quant, but not your own story.
So basically say here we are. As a portfolio constructor, you've got these risks, and it's very, very hard to diversify discount rate risk. And so the one way you because all your assets are exposed to discount rate risk. And so the one way you might have a chance, I can only say might have a chance, is through alpha and active management and long short. And I go okay, there is a predominant form of alpha in the world today, which I'm going to call buy high, buy higher and mark up and call it alpha, or buy high, lever up, buy higher and mark up and call that alpha. And I think we'll find in the crash that was not alpha, that's beta. But proper long short alpha buy and sell stuff, if you have a basket of stuff that you're long and a basket of stuff you're short, you have a fighting chance of being discount rate neutral, right? If you're long equities and short equities, they both expose a discount rate shock, you have a chance. Now, the betas of the two, the discount rate shock, who knows? And so you look at it and you go, it's a fighting chance, and I think it's going to come in a very, very important, extra arrow in the quiver of investors going forward, especially, it's very, very important. The problem is the vast majority of long-short alpha processes out there have really struggled over the last, 5 to 10 years. And so this is like the conundrum, because unless you're like literally just playing this, like, I wouldn't call it a great fool theory, that's totally unfair, but a get there early and hope enough people come in behind you to push the price up form of investing, like unless you play that game, it's been very, very hard in the long-short space. And so, and I think like, and I'm going to take like a 5 minute sort of like, and talk about like, and I know I did this in 2 years ago, but just to go through it again and go like, how have investors traditionally made money? Right? I think this is really important. And so like, I will do it again, and I apologize for people who are going to hear this for the third or fourth time, but like AQR wrote an excellent paper, and I think it's just very important to kind of back into it for a second and go like, Warren Buffett, Bill Gross, George Soros, right? Like three of the most famous discretionary investors on the planet. And in this paper, they kind of went through and they regressed their returns, and they said like, how did they make their alpha over the years, and they were able to explain the vast majority of the alpha from those three traders through what's now known as the modern alternative risk premiums, right? And so, okay, that doesn't tell you all that much just yet, except to say that the discretionary guys were doing what the systematic guys were doing, and everyone's kind of doing the same thing, which makes some sense. It's hard to make money being short things that tend to make money over time. It's hard to make money being short equities. It's hard to make money being short, like credit. It's hard credit spreads.
Anything with a persistent positive drift.
Anything with a persistent positive drift, which is all the things we just mentioned. And so, but now the onus is on you, and this is where the storytelling starts. Is like, why do these things have persistent positive drifts? Okay. No one has to justify why the equity risk premium is expected to make money over time, or the fixed income risk premium. I'm lending, and I know when I lend someone that I'm expecting to get paid back more than I lent them. Right? And so we expect that there's a flow of wealth from you to me when I'm lending to you, and no one debates that. And you expect to lend me more than I lent to you. They go like, so what about these other things? Why would there be a low vol risk premium? Like, what could possibly explain that? Why would there be a value risk premium? Why is there a credit default risk? Why is there a vol selling risk premium? Why is there commodity back con premium? Why is there trend following? And so I think like instead of saying, hey, these things made money and they worked, and let's just accept that that's a fact, I think you got to come back and go, why? What is the driver? And I think like the key feature of that driver is that every single one of these is an anti-crowded play of some sort or another. And so you go, what do you mean by anti-crowded? You go, you can look at each one of those risk premiums and say, there is a concentrated set of players who are happily paying wealth to another set of players because it's in their best interest to do so. And so I know we talked about this a couple of years ago, and the key feature is that happily and on expectation paying money from one set to another. The same way as the equity risk premium and the fixed income risk premium, there's payers, there's payees, and they're both happily entering the transaction. But why would anyone persistently pay money away on expectation? Because does that seem like completely irrational? You go, no.
Which flies in the face of most people say they're willing losers, right? That you are stealing money from those losers.
I don't know. If I buy a chocolate bar from you and I spent $1 and I got a chocolate bar, I'm not a loser. I'm happy. I wanted that chocolate bar. I was willing to pay more than $1. And so like, this is a marketplace. If we can get together and I can give you something that makes you better off, and I can pay you some money for it, and we're both better off, we're both winners. There's absolutely not a loser in that game. And that's the key feature of a risk premium, is that there's this transfer of utility where both are better off. Through and it can be through money, it can be through a transfer of risk. There's lots of different ways. We say like, so my thing, if you look at each of these things, go, why? What are the drivers? Why do people get caught paying money away, and why are they happy to do it? And so I have like three, and this is just my story now, but I got three kind of drivers that I think explain why people will do this, right? And types of crowding, because it's like I said, it's always from a crowded trade to an uncrowded trade. And you go like, the first reason that people get crowded is for structural reasons, right? Like, and I can talk about this as like regulatory or governance, and they're forced to trade in a subset of the universe because they're constrained investors. The second set of crowdedness is going to be called behavioral. And people get crowded because it's just human nature to do the same things as everyone else, and that like naturally creates a set of crowdedness. And so if you can find the other side of that trade, there's a flow of wealth. And the third type of crowdedness I'm going to call natural long positions. And when you're naturally long something, you demand insurance. And so there's insurance risk premiums for people who are naturally long one side of something. And go, that explains every single one of the modern alternative risk premiums, and every single thing that the Buffett and the Soros and the Bill Gross, everything that they found and kind of came up with intuitively over the 20 or 30 years, they discovered and they intuitively went, oh, here's a pocket of crowded, here's a pocket of underloved, and there's a flow of wealth. And so, like, to give you some examples, like structural. Like, and by structural, let's go, it's just my terms, but I go, constrained investors, and you go, okay, investment grade, credit. The vast majority of investors who invest in investment grade, who invest in credit, are forced to only invest in investment grade, right? The vast majority are constrained investors. They can only do investment grade. In fact, a ton of them can only do or spend all their time in the 7 to 10 point of the curve because there's a, this is the liability immunizing discount point for pension plans. And you go, so these are very crowded trades for natural reasons because they're meeting someone's utility. And if you're an investment grade, investor and a name gets downgraded, you have to sell it, right? And it goes from being a crowded asset with a high price and a low return. And when everyone forces to sell at the same time, it falls out and it becomes suddenly this underloved, overlooked, low price thing with a higher expected return. And these people happily sell it because it's in their best interest to, because if they don't, they get fired because their governance says you cannot own this thing. They're constrained investors. And by definition, any constrained investor who bumps up against their constraint would mathematically rather have that thing. But if they can't, so something bumps up to your constraint, and you can only have so much or not of it at all, it falls out of it, you on expectation would like to have it in your portfolio. It means that you expect it to be accretive to you, which means by taking out, you expect that you're paying someone else to take it. And so there's an expectation of flow of wealth, but you happily do it because it's in your best interest too. Now, if you're an unconstrained investor who isn't forced to only invest in investment grade, buying the fallen angels is a well-known strategy that significantly outperforms. And so this is like just taking advantage of like the effect of a constraint and kind of the gradient between the constrained and the unconstrained investor, and there's that flow of wealth across that gradient, right? And so I think that one's pretty obvious. I mean, you have other structural might be, like low vol is explained because you have a bunch of investors who cannot use leverage or who have a very, very strong negative utility of leverage. And you go, okay, in the maximum Sharpe ratio world, I would invest in all things. I'd use my risk-free rate to lever up the low stuff, which, by the way, is what Warren Buffett did. Right? He bought low vol names and levered them up 1.7 times, and that was a massive source of his alpha because a lot of people can't or won't. And so you get crowded in the naturally volatile asset classes. And I know we talked about this last time, but we found this in every asset class we looked for. We first found it in fixed income because we went why is the 30-year bond such a lower Sharpe ratio bond than the 10-year bond? And why are those both lower than the 5-year bond? It's like, well, I can tell you what a pension plan does when they want more fixed income duration. They don't lever up a 5-year bond to the dollar duration they want. They move along the curve like everyone, and they get in the back end of the curve becomes very crowded. It has all the volatility and half the return. And you go, well, that's a loser trade. But if you can't use leverage or you don't like leverage, that's what you have to face. And so in every asset class we looked at, the naturally volatile asset class has a lower risk-adjusted return, and the lower volatility asset class, if you can lever it up, is a higher risk-adjusted return, and it's a superior investment. It's a flow of wealth between the constrained and unconstrained. I mean, you have tons of structural players who if you're an ETF guy and your job is to match the index perfectly, right? And you go okay, so if I told you, hey, I know that a name is going to get added to the index and you should buy it early, there's some alpha in that, and because you'll buy it before everyone else and you'll do better. And I go, not my job. I don't want to make alpha. I want minimum tracking error. I just want to buy it when I'm told to, like everyone else. I want the exact same return as everyone else. So when it gets mentioned, when everyone else goes to buy it, we buy it at the same time. I have no tracking error. That's my job because that's my utility. And so at the same time, I know there's a flow of wealth out, but I'm happily doing it because my job and my definition of my utility is different than maximum Sharpe ratio. And so you can argue anyone following a set of rules who's being forced to follow a set of rules, and there's enough people doing it so that it becomes a source of crowdedness, is going to have a flow of wealth away from them. And so that's structural, right? Behavioral is much easier. Behavioral is just it's just humans love to do the same thing as other humans. It's naturally, it's very, very hard to go against the crowd. And so this explains trend following, explains value. At the end of the day, what's value? Value is this name is getting sold down. It's getting sold down too far. It's getting sold down because by definition, everyone hates it. And when everyone hates something, there's a reason. There's a story. There's a scandal. There's a competitor doing well. There's a competitor doing badly. Who knows? At the end of the day, there's going to be some reason why everyone knows this thing is a dog. And it's really, really hard to go against the flow and go, I kind of like this guy here. And it takes a weird intestinal fortitude to do that. But if you can do that, you should capture a risk premium. Once again, concentrated, unconcentrated flow of wealth. And so the utility that you're transferring is the sense of safety of being with the crowd, right? And so and that's the utility that they're buying, and that's what if you're willing to pay that pain, you can capture that risk premium. And there's lots of examples of those. And then the last one I would say for crowdedness is the way I think of it is, natural long positions. And we talked about this as well, but it's if you're a farmer and you got a field of corn, your entire livelihood is tied on what the price of corn is going to be in 6 months. You don't want that. Like Rod, you don't want to sell all your, all your wealth and buy only corn futures and sink or swim on what corn's going to do. That's a garbage trade. Like if you're a farmer, you want to be in the business of growing corn, not speculating your entire life's wealth on what the price of corn is going to be in 6 months. So you need someone to insure you, right? And like any form of insurance, like if you go buy house insurance, you know that you're doing it at an expected loss, right? You know the insurer is expecting to make a profit. So you understand that you're doing it at a loss, but you're doing it happily. Once again, you're paying that money away, that premium away, because on expectation, you're better off. If your house burns down, that's a catastrophic loss. You can't afford that. And so you pay some small piece of your wealth, but you a massive tail hedge and you're better off. You feel happier for that trade. And the insurance company takes what for them is a tiny sliver of return and an even tiny sliver of risk that diversifies away. If your house burns down, it's 1 in 10,000, they're fine. And so they are net accretive. Their risk-adjusted return is higher. Your risk-adjusted return is higher. You're both better off. You're both happily into the transaction. But there's a flow of wealth, right? And there are tons of those risk premiums. And, and what makes it exciting in the commodity world is it's like, the farmer is long corn, but Kellogg's is short corn. And so the first thing that happens in the futures market is not that you go to a speculator and pay them insurance risk premium to cover your insurance risk. When you go to the speculator and you go, like first of all, Kellogg's and the farmer get together and they insure each other mid, right? That's why the futures market is so amazing. It's because for free, these guys insure each other. But at the end of the day, one of them is left holding the bag, right? Supply demand imbalances and all the substitutes available is either the insurer, or
well, they get exactly what they want at the time that they make that deal, right?
That's right. And so once that imbalance goes too far, there's either not enough people to supply the insurance on the other side, or the price gets too high, and that's where the speculators will step in and take the difference. And so, so that's it. So those are the three major sources of crowdedness, right? And so the genius of the Warren Buffett and Bill Gross and the Soros is that they realized that within each of these major asset classes, right, were a ton of long-short portfolios that could be created within them that were the function of supply-demand imbalances or crowdedness imbalances that you could isolate, and that they persistently made money over time, right? Okay. Yep.
So I don't mean to interrupt, Chris. I think this has been sort of one of the most well-established narratives over the last decade. I think that's what a lot of the smart beta growth was on. I like your phrasing of crowdedness. I am curious, though. I mean, again, a lot of these trades have now become prepackaged and available in a way that they weren't 30 or 40 years ago. Yeah. Even if I knew about fallen angels as an individual, it was very difficult for me to put fallen angels categorically in my portfolio until Van Eck launched an ETF. And now there's hundreds of billions of dollars chasing these structurally, which is going to have a reflexive impact upon whether these premiums can even continue to exist, right? Because there was a consistent set of, or not consistent, but there was a supply and demand imbalance. And now all of a sudden, we've eased access to one side of the trade. And I don't think there's more people on the other side of the trade, right? So you would expect the premium to diminish. I'm curious as to where you think blue ocean remains in this space, because to me, it seems like a lot of the empirical evidence would suggest that the premiums have been dramatically squeezed over the last decade.
Right. Would you say that those trades are getting crowded?
Absolutely.
Okay. So this is like and this is it. They're anti-crowded trades that themselves have gotten very crowded. Right. It requires a gradient differential. And what happens if enough people come to here? What happens if more? Like if you're going to buy insurance and there's only 2 insurance companies, they can probably charge you a pretty hefty insurance premium. They're going to charge you some fair fat amount. If you come back and there's 50 insurance companies offering you insurance, presumably that's getting squeezed pretty hard. And if one of them is crazy and wrong, maybe you can get it for less than it's worth. At the moment, these anti-crowded plays themselves have gotten shockingly crowded, and that has really, really hurt the space. And that commoditization of the space is the main challenge and the problem. But it's not. And so my point is, it's not just hurting the systematic guys, because the discretionary guys also kind of do the same stuff and have for a very, very long time. And so in many ways, it's hurt everyone. And like I said, if it's not a buy high, sell higher markup type of trade, it's a very, very hard space to be in. So what we started doing was, I would say this is even back in 2010, 2011, when I first started the bones of my first sets of ideas around this, was thinking oh my God, the space that we're in, which has done really well for us. And we had a great narrative back in 2004. Because back in 2004, this narrative, when we put it out there, the response was, and I had a very, very supportive set of bosses like Wayne Cozen and Mike Witzel and Neil Petroff. They were all they gave us unbelievable amounts of time and leash, and we built some really good stuff, and it went really well. And I would say like at that time, I think we put together something pretty like relatively innovative, relatively early for a pension plan. But by 2010, 2011, I was hearing the same story that I just told you back at me from everyone. And it was other pension plans. I mean, I talked to tons of pension plans, like, you guys should all be doing this. And I talked to other hedge funds, and you heard it from bank products started really like coming out, like I said, like in the ETFs. And so this story, which was in itself an anti-crowded story, began to get extremely crowded. And I went, what are we going to do about this? Because this is our space. This is going to cause problems. And so like the first thing, and like I said, you're always innovating. There wasn't like now we're on to the next thing. It was a constant, like, what can we do about this, and how do we take advantage of this, and what are the implications of this? And so what we really started to like think about was like, how can we take advantage of this crowdedness in this space? Because like when I said, like you talked about those structural guys, the ETF who's following a set of rules and doing something, everyone's doing the same rule at the same time. What was very apparent to us was that everyone was doing kind of the same things. This is like the beauty of systematic investing and the massive challenge of it. And like I say, once again, not just like all investing, like doing something similar, but if you're a trend follower, and like we built a CTA. Our CTA had like I think at first 5 different models, right? We had a moving average crossover, breakout, some regression slopes, like regression crossover, like zero correlation, and like different ideas. And very early on, we were doing an ensemble approach with all the different parameters we can come up with. And the kind of weird thing was like they were all like 80 to 90% correlated, right? They all did roughly the same thing. And really, when a big trade came, they all were trading at the same time. And then we went to talk to managers because one of the things we're doing at Teachers is we had a external manager portfolio. We went to talk to managers. And we'd always be very careful and say, like, we're running a prop shop, and we have but our filter was typically send us your daily returns. We'll regress it against our internal model suite, and we'll see who's doing something different. And the sort of the crazy takeaways, you got 200 sets of returns. Like you could fully explain 170 of them with with what we were doing. We had a very scorched earth approach, and so it was like, oh, our models are saying that they're all kind of the similar. When we talk to managers, they're all kind of doing the same sorts of things, and we were looking for the crazies doing like stuff like a bit different that we couldn't do. But like the takeaway is like this stuff that we're doing. If I'm buying crude on a Wednesday morning, like so is everyone, right? I have a pretty good sense of what like a good chunk of the world is doing because I've been running it myself, and I have a pretty good sense that that's pretty indicative of what a lot of other people are doing. So it wasn't like I can go back and say like I know what everyone else is doing, but I say I've got a pretty good indicator that my model suite has gotten crowded. And so can I start staring at my own model suite and start to look at the implications of how different bits and pieces interact, and when has something gone full, and when has an asset got crowded, when has a model got crowded, when have parameters within assets within models gotten crowded, and start to get a sense of like what are the implications of that? Because once again, when anything gets crowded, you want to get on the other side of that trade. If you can find the relatively uncrowded piece, you can build a long short book, right? And you can build long short books because when something gets crowded, either its returns get driven down or its risk gets driven up. And you can build a long short book by 2 things where I think this guy's got higher return than this, and I have no view about risk. You can build a long short book where I go, I have no view about return, but I think this thing is riskier than this thing. So this is higher, like this is lower Sharpe ratio, and this is higher Sharpe ratio, and I can still build, a flow of wealth between a higher Sharpe ratio and lower Sharpe ratio just by focusing on where I think the sources of risk are. And we can start to we can look at the asset level, and look at the parameter level, the model level, and so we started to build a ton of anti-crowded models within the alt risk premiums themselves, right? And the key feature about that, and the kind of the cool part of that, is that they are themselves alt risk premium neutral, and they're also beta neutral. So you're equity fixed income neutral on average over time, and commodity neutral over time, but you're also trend following neutral over time, and it takes a lot of work, and keeping it that way is challenging. But we have like these 20 models, and the key feature of them is like they're properly uncorrelated, because like the average cross correlation term over the last 3,500 days is like 0.03. So like they're properly different from each other, and then of course, like anything, it becomes a portfolio construction and risk question to make sure that you can keep those guys uncorrelated and keep them diversified and size them right, and build a trusty portfolio.
Just to unpack that a little bit, Chris, when you say you're looking for anti-crowded factors, that might be interpreted as you're looking to arbitrage crowded traditional factor plays, but I don't think that's quite what you mean, right? So
yeah, so
take us through more.
Arbitrage is the wrong word, but like if you kind of go like, look, how do you make money in this world? Like how do investors make money at a very, very high level? And this is going to be crazy simplistic and probably wrong, but I'm going to go with you have to be early or you have to be different. Because look at it the other way, right? If you do the same thing as everyone else, if you literally have the exact same portfolio as the average person, you should expect median returns. That you cannot expect to outperform to do the same thing as everyone else. If you do the same thing as everyone else and you get there late, you should expect to underperform. And so the key to alpha in this world, the key to outperformance is early and different, or early or different, if you can do both of them. And so what we're trying to say is like there's two sources of alpha for an allocator, right? There's your manager's alpha. And so I can say as a manager, what are we trying to do is like we are trying to be early and or different across the board, or we're trying to stay away from crowded. Like you have to stay away from the crowded trade, or you have to find the uncrowded trade. And so what we're really trying to do is that you can either anticipate flows or avoid crowded positions. And in both of those cases, once again, crowded positions can be imputed lots of different ways. Like we do it from looking at our own internal model suite and going, where is this fully crowded? We can anticipate it from. We have one model that's it literally has just a bunch of trading rules, and they're kind of nonsense on their own. There's a whole bunch of trading rules. They have a whole bunch of different utilities and a whole bunch of agents that we simulate doing their thing. And if you just follow the trading rules, it doesn't really do anything. But the real key is like as those trading rules interact, when do they get crowded, and what are the implications of that crowdedness? How can I lean against that crowdedness when it happens? And so we're not just going after the systematic crowdedness. We're trying to capture the best of our ability, like lots of different sources of crowdedness. And then, of course, the key feature in all these is that every single one of these models starts with a story to myself, a thesis, right? And then once you have that thesis, we start going to look for it. And then, there always is a dynamic part to it, which is like the bones of the idea can be very, very stable, but you have to make sure you're constantly adapting, adjusting, because the market is not stable. And the instability of the market, of course, shows up in volatilities. You have to always be adapting volatilities daily to adjust for assets change. The instability shows up in betas. Betas are if something has changed, if you talk about what has changed in the last 10 years, like volatility is, vol is way higher, right? I mean, if you look at lots of different ways to look at it, the crash, take 87 out of it for a second, but like 2000 to 2003 was like 3 years, 2008 was 6 months, 2020 was, 2 weeks, very fast, very ferocious. Vol has gone through the roof, but also like the betas of interactions of things that used to be uncorrelated have suddenly become far more correlated. And the speed of that change has changed as well. And not only has it drifted higher, but the movement of those betas are much quicker. And so like one of the major sets of efforts and transformations is like, how do I keep these ideas uncorrelated? How do I keep my assets within my models uncorrelated, which is obviously a huge fight. And then how do you keep the models themselves uncorrelated to each other? Because if pockets of a bunch of models, they're interacting. And what happens if 9 of them go long S&P? What happens if 14 go long S&P? What happens if 20 go long S&P? And how do you handle that?
I was going to say there's only there's only a certain number of markets, right? You're talking about 20, 25 different models, but they're all interacting with a small universe of markets, right? So
right. So here's the thing:
when you start to look at the overcrowded trades,
when you start with markets classes. on the left side, you've got stocks, bonds, commodities, FX. Vol. I don't know. You can put a couple of, but let's just say like roughly speaking, those are your liquid assets. I'm going to call that 2.5 asset classes. Or 2.5 risk premiums there, because stocks are a risk premium, bonds are a risk premium, commodities. I'm not convinced the long side to commodities is a risk premium, and maybe a bit, but I'm going to say not necessarily. Like I said, the risk premium to the farmer or the risk premium to Kellogg's, who knows? It can be either side. And then FX doesn't even have a long side. You can't talk about the long side of FX. So there's obviously risk premiums within these things, but there's only 2.5 assets. Now you break commodities. I think commodities is a complete misnomer. It's like commodities is like saying stocks and bonds. Like it's got at least 5 kind of different things inside it. So maybe commodities is. If you look at that set, let's say I got 7 assets. It's a bit of a stretch, but let's say you got 7 kind of things there. The interesting thing is once you start to transform things through models, they become more diversified. You get more effectively independent assets, right? If you think about trend following, right? Like trend following, if I got let's say U.S. and Canada equities are 80% correlated. I can tell you with certainty that after you trend follow U.S. and Canadian equities, their correlation is less than 80. I don't know how low it is, but I can tell you it's less than 80 with 100% certainty, because there's only 2 cases. If your trend following model is exactly for every time you're long S&P, you're long Canada, and every time you're short S&P, you're short Canada, you have the exact same signal for both of them, then you're going to be 0.8 correlated. If you are ever long S&P and short Canada, or even half long S&P and full long, anytime your signals are a little bit disparate, the diversification of your signals kicks in, and the correlation between trend followed S&P and trend followed Canada is below 0.8. And so what you see is as you run things through these transformations, these models, you end up with a more effectively independent asset. So maybe you go from really what's more like 4 or 5 to maybe 10. Now, if we're doing a second version of that, Now I'm going long, short trend following, which is going long, short S&P 500. And you got a second generation. And what you'll see is the average cross correlation term of your assets has transformed through a model comes down again. And so you get more and more effectively independent things to play around with. And so that's a huge boost to diversification benefit.
Chris,
that you can capture as you start to do that.
Can I play a little bit of devil's advocate to that?
Yeah.
Wouldn't that implicitly be true whether your signals have value or not? Because you could just say, I'm going to introduce a random variable. That random variable that is your signal is going to, right? So to your trend following example, it doesn't even have to be trend. If you just had a random variable, you're drawing a random normal, and that's how you were position sizing your US equities, and you're drawing another random variable to position size your Canadian equities, right?
Yep.
By definition, you've introduced a new asset, but it doesn't mean that asset, it is an independent bet, but it doesn't mean it's an independent bet with value, right? It doesn't mean it's actually a new asset that's additive to your process in any way.
100% agree. It does not necessarily say that at all, but you hope that your trends following transformation also has some alpha in it that does create some of that value. So now I have some value created and a more diversified basket. And so look, if your transformations are random, yes, your correlation comes down, but I'm not sure that's going to help you in any way. What you're looking for is additive, accretive signals. But just know that as you add those accretive signals, as you go layers deep, that your effective diversification, the number of effectively independent assets you have after those transformations rises, which is what I'm getting at. And if those things also have
but I think that's somewhat what's the word I'm looking for? Like, it's by definition, it has to be.
Yes.
Right. So yes, I agree. It's introducing more diversification by definition. It's a question of whether that diversification is valuable.
Well, so yes, and so if you look at it, you say, if I have things that have a lower correlation that also have a positive Sharpe ratio, that will create a portfolio. Yes, that's valuable. Like diversification on loan. Like if you gave me 10 uncorrelated things with 0 expected return, no. At the end of the day, when you're portfolio constructing, when you're building ideas, when you're putting models together, you're trying to find positive expected return things that have relatively low correlations. That's how you build a portfolio of ideas.
May I put an asterisk on that? If you're rebalancing at a certain frequency, you might actually be able to provide a positive expectancy portfolio because of the rebalancing premium, right? Shannon's demon and all that. So diversification on its own with proper rebalancing might actually be accretive for 0 expected returning assets.
Yeah, but then I would argue that's a source of alpha. I would just say it's a source of alpha. That is so I would say, like, you could take a non-rebalanced portfolio and a balanced portfolio, find the long short book that is your rebalancing premium, call that alpha, extract it out, maybe even blow it up and put it back in if you want to. And say that's a brand new, that's a source of alpha for sure.
Yeah.
So like and that noise capture, that's like, look, I mean, there's a whole bunch of quant factors where people didn't realize that, like, you could go long the quant factor or short it. It was the equal weight of the factor itself that was outperforming the underlying, like, the benchmark that they were fighting against. And so, like, this is one of those interesting things about equal weight. Part of the outperformance of equal weight is that volatility capture, for sure. And so you'll see that with, like, part of the outperformance of value weighted. Therefore, is there some of that noise capture? So, yeah.
I want to get into crowding as a bit of a social phenomenon. Like you described 3 reasons why things could get crowding. One of them is behavioral. And I want to get into whether you think the advent of social media has, to an extent, exacerbated an emergent kind of social phenomenon, right? And we talked on a previous occasion about riot theory and how riot theory may help to explain the the emergence of crowding. How do you put those pieces together or think about that?
So there's I took an urban economics class in, like, I don't know, 3rd year for fun, and it had this, like, crazy for fun. It was great. I quite enjoyed it. But anyway, so it was like, and it was a pretty neat class, and so it had a couple, like, cool things. But one of them was, like, there was 2 classes on riot theory, and so let me back up for 1 second, because, like, human synchronization is such an important topic because the entire efficient market hypothesis assumes a bunch of independent rational agents, and it doesn't assume what happens if everyone does the same thing at the same time. Like where is what are the implications of that? And it turns out they're ferocious, and if you look at it, you go like humans at times will naturally synchronize, and it just naturally, like organically, and I think like there's some really cool videos you're looking at on YouTube where it's like, it was like there's an audience in like Prague or something at the end of a concert, and the audience is all doing their independent clapping, and at some point somehow like some tipping point is reached, and there's enough of like people clapping at the same time where the whole audience goes like, and there's a tipping point, and suddenly everyone's clapping at the exact same time, and you can see the audience going, what's going on? This is weird, but it's like it's suddenly you've got 5,000 people just naturally organically synchronizing, and you go that's cool, no problem with that, right? That's kind of a neat story, and then you have like other kind of synchronizations which were like maybe can be more destructive, like in 2000, London built their Millennial Bridge, right? And it was like this brand new, very exciting. They opened it to the public for the first time, and they closed it 2 days later because it nearly tore itself apart in the first 2 days. And the issue was like everyone knew that like if you put soldiers across the bridge marching at the same time, like that could be a natural frequency, and if you get that wrong, the bridge will oscillate to it and you can destroy it. So engineers know that, and so they make sure they engineer bridges without the natural frequency of human footsteps. What they got wrong here was that this bridge had enough flexibility to it that when people started walking, it started to sway a little bit. And as it started to sway a little, a tipping point was reached, and suddenly everyone had to start walking at the same time because they're all counterbalancing the sway, and it started to make it sway more and more and more. And so they had forced a synchronization on a group of people, and that forced synchronization was extremely destructive because these things become naturally self-reinforcing, right? And that's what the riot theory was actually about as well, because the riot theory was like, it's like there's a continuum of people. From people who are willing, and this is riot as in like who's willing to get out there and throw a rock and smash a window, riot theory. And if you think about it, if you've got like a certain percentage of the population is just willing to go out and throw a rock and smash a window at any time, right? Because yeah, why not? And the why not that most people answer is because I could get arrested or go to jail or get caught on YouTube and face like get fired because there's repercussions, and the fear of that repercussion is what stops some people from doing it. Now, there's some people who would never. Doesn't matter how. If you guaranteed you never get caught, some people will still never get involved in a riot. But there are plenty of people who go, it might be fun. Why not? And if enough people, and as more people get involved, it starts to get safer. It's the same thing. Like there's a great video on YouTube of people dancing, and the first guy out there dancing by himself on the field, I think he's high as a kite, is just doing his thing, and he's by himself for like 10 minutes. And then the second dancer comes in. And it's always the most important dancer is the second dancer. It's the person who joins, and someone will go, oh, that's cool. And the next thing you know, everyone joins. And it happens very quickly. There's a tipping point, it turns over. Riot,
that's my specialty.
That's right, exactly. So riot theory is that. It's enough people get involved. You got 5 people walking down the street, like smashing windows, the police can arrest them. But if 10,000 people go down the street, the police have to just step back and try and clean up the mess the next day.
Harold DeVore from TransFriend has a really good invocation or metaphor of this as well with flocks of birds, right? Yep. So think about migrating birds, and they're flying down the coastline, and only a very small fraction of the birds knows where they are at any given time, right? And it turns out they've modeled this, and they've been able to confirm it empirically that so long as a number of birds equal to the square root of the total size of the flock knows where they are at any given time, then there's enough sort of whatever it is, mimetic sort of gravity between the flock that it can keep the flock flowing in the right direction, right? It's like this criticality of information that then allows the entire group to rally in the right direction, right?
Exactly.
All kind of the same phenomenon.
And so that's what I was thinking. So I watched that video on clapping. Actually, it was the one on clapping. I went, that is so crazy how humans can get together and suddenly they're all working together. And I thought, that's a lot like what's happening in investing right now. Because at the end of the day, like the efficient market hypothesis kind of goes like we're all independent beasts. And he goes, well, what happens? Like, and we always had investment clubs, and you had hedge funds who controlled a lot of money, and pension plans who like collecting more money, but like. What happens when you have like a Reddit army of 3 or 4 million people who get together and they go, here's what we're going to buy today, and we're going to try and and it's sophisticated, like not like like we're going to understand we're going to like understand what the pressure points on the short sellers and what a gamma squeeze is, and but like, hey, if we all get together and no one sells and everyone buys, like what will happen? You go like that giant collusion, if 5 people go walking down the street smashing windows, you can arrest them. If 10,000 people go down the street smashing windows, that's a riot. You got to step out of the way. And that can expand. That can like if enough people get into it, it can go across the entire country. If 2 million people are walking down the street, that's a revolution, and that can overthrow a system. And who knows what the system's going to look like the next day? And I feel like there's an interesting, we're at a very very interesting time right now because there is a bit of a revolution going on where suddenly we've got millions of people going like, we can all in concert attack the market with a stated goal of disrupting it. You know, we're not
in a way that didn't exist even 10 years ago, right?
That's right. And
whether it's Reddit, Twitter, whatever the kids are using these days, Twitch, who knows?
Super interesting to talk about, like synchronicity and how humans synchronize, and whether it's organic or whether there's something forcing people or allowing people to synchronize, and then understanding that synchronization can be extremely, extremely disruptive. And so what you see is like changes in the marketplace, like dramatic changes in the last couple of years. It's the amount of sort of short, the fact that the typical investor was a vol seller has like maybe a bunch of them at the daily level now, like massively long vol. And you have to understand what are the implications of people who are just like massive amounts of long optionality and long volatility. What are the implications to the marketplace, and what are the implications of the marketplace now that a bunch of pension plans can no longer sell volatility because Aimco had a blow up and the boards won't let them, and suddenly these are short-term events that can transform things dramatically. And so as an investor, you have to keep an eye on them and understand and start to try and model what are the implications and how do I need to react to the fact that this market day today is dramatically different than it was even 2 years ago. And the key feature being vol of vol, correlations, extreme moves, correlations in the tail, big, fast changes in beta as a result of all of those. To me, it has been such a difference in the market over the last 2 to 3 years.
Especially when you're trying to keep it neutral, right? Yes. When you're trying to take all of that off every single day.
Trying to take that off, yes, yeah. Very, very hard. Yep.
Chris, I'm curious as to your thoughts about what I would almost consider to be regulatorily promoted synchronization. Right, so there's been a push. I'll use target date funds in the U.S. as an example. It's a $5 billion exposure in the early 2000s, now north of $2.5 trillion, being used as the primary savings vehicle for most white-collar employees, operating in a very synchronized manner for the most part. There's small deviations in how the glide paths are defined, but how does that sort of play into your view? Is it sort of play back to the way indices are constructed, and there's some forced synchronization there as to how capital's deployed?
Yeah, I know you guys have had Mike Green on a ton. He's awesome, and his story of what is that's some great synchronization when they buy equities buy the exact same package at the exact same weights, and what are the implications of that? Obviously, I love it. You're trying to buy Microsoft, but Bill Gates isn't selling his Microsoft, and so that market cap is wrong, and the synchronicity of that is creating massive distortions. Any regulatory set of constraints is going to cause inefficiencies, and so if you're aware of them and you aren't forced to take advantage of them, you should be able to take advantage of them, right? And you're not forced to follow them; you should be able to take advantage of them. And I would say look. The great synchronizer, and we're not going to talk about the Fed because I'm not a global macro guy, but the great synchronizer has got to be the Fed. Because like I said, we went from a whole bunch of idiosyncratic factors to not even was growth good or growth. I mean, the job this has been like this for a long time, but the job numbers come out bad and the market loves it. Bad news is good news. Why? Because the Fed, is going to respond to it in a way that's favorable for equities. And so that's the entire story right now. Is what is this one institution going to do? And have they ever created a massive instability? And we're all riding a tiger. We all got on this tiger in, I don't know, I would say 97. Some people might say 2008, but whatever you think that the Fed really started messing with stuff, we've all been on this tiger for a very long time, and I just don't see there's any way off. And so
we chatted about this on other occasions, right? But as systematic investors, right, who are students of history and the relationships between discount rates and valuations and expected forward risk premia, et cetera, and who understand or are observing these phenomena, these sort of macro memes playing out over long horizons now, where everything can get pushed to extremes that we've almost never seen historically. As systematic investors, how do you think about navigating some of these? I mean, we talked about a microcosm is kind of the Toronto housing market, but this applies to a wide variety of other markets around the world. I would argue it applies very directly to U.S. equities, as an example, for reasons partly described by or explained by what Corey described, right? But as quants, how do we navigate markets that are so clearly dislocated because of these types of emergent social phenomena or coordinated or like social synchronization.
Okay. I got a story for
let's
this.
do it.
So when I first started at Teachers, I was in a group called R&E, and we played like on our very first offsite. I was just out of school, and we were like these are people who were like, this was like the tactical allocation team. There was some groups that were responsible for construction. There were some risk people. There was a vol seller, fixed income guys, some people who were like librarians. It was a hodgepodge. And so in our offsite, as a sort of get to know you, we played a game. And if you guys have heard this game, like don't jump. I'd love to see your thoughts on it. And the game was this: everyone, we're going to write down a number on a piece of paper between 0 and 100. Okay. I want you to write down 2/3 of what you think the average person is going to write down. Yep.
I know Butler too well for this one, I think.
All right. What's your answer, Adam?
Well, I know it, so I'm gonna refrain.
Okay. So, yeah, you sit there for 1 second, and go, well, like it may take you 5 seconds, it may take you 10 seconds, go like clearly it's 0, right? Like the answer is 0. If you put 2/3 of what everyone else puts, and you put 2/3, and you put 2/3, and it's got to go very, very quickly down to 0. I think
if you're in a room of economists, it is 0.
No, of course it's 0.
If you're not in a room of economists, it's not.
Of course it's 0. So, but that wasn't the question. The question wasn't the right answer. The question is, what is this room going to put down? Put down 2/3 of it. And so we I put down 0. I was like, of course I'm right. And I was so wrong. I was so wrong. The number, I think the average was like 30. And so after they walked around, they asked someone put 75. They just didn't understand the question. Like someone else very proudly went, well, everyone's going to put 50 on average, so I put 33. And someone else went, well, I thought someone else was going to put 33, so I put 2/3 of that, like 22. And one person went, I looked around the room, and I went, I think some of these people are going to go one generation deep. Some are going to go to 25. Yeah. That was the right answer.
Exactly.
Right. You go down to maybe 3 derivatives, right? 3 levels, and you stop there. That's
this is like.
Depends on how much you respect the crowd.
This is a
the problem is,
I went straight to 0 with you for.
If you know to go more than 1 level deep, then you'll go all the way, right? So it's that's
the problem. Some people only went 2. So anyway, just to say, you think so, and this is the problem. You are not investing against the right answer. There is no right answer. You are investing what other people think the right answer is, or what they are going to go do at some point. You are investing against other people, and they're not all as smart as you. And so you look at it and you say, like, this is like, and in 2007, I was like, this housing market is insane. Who still buys it? And the answer is a lot of people, a lot of people. And so, and then when 9 out of 10 housing markets in the world crashed and Canada didn't, and everyone went, see, it was the right thing to do. And this is a very, very important thing. There's a bunch of takeaways on this. But the fact is, first of all, I'm terrible at this. I'm terrible at trying to figure out what the average, what people are going to do. I completely get it wrong. and so, this is why, as a quant, at the end of the day, you have to think about it. You have to put yourself in the shoes and go, what is the average person going to do? And the average person is going to go, look, just because I would say, if 9 out of 10 real estate markets in the world crashed, what's the riskiest real estate market in the world still? And I would say it's the one that hasn't yet crashed. But the vast majority of people go, look, this market's never crashed. It's safer. And in fact, you have risk people. You have risk people at prestigious pension plans going, like, real estate has no risk. It's like, because yours hasn't crashed. They go, well, I put my returns into the system, I throw it into the optimizer and go, we should do more real estate. And it's like, ouch. But at the same time, if enough people do that, this is the moral hazard trade. And I get it wrong every time. The moral hazard trade is that if enough people do it, at some point, the government goes, look, if I owe the government $1 million, it's my problem. But if I owe the government or the bank, $10 billion, the government and the bank have a problem, they cannot raise interest rates now. So that was the right trade. It was the right trade. It turns out there was an institutional put in behind it to protect it when enough people did. I cannot answer from a discretionary perspective. What do you do in this world of excess? Because I always go, stay away. It cannot. I know how it ends. It has to end badly. And I think that's the genius of George Soros, who goes, anytime I see a bubble starting, I just want to get on it. I want to get on it early because I can because that's how you make money. And so I'm a run away from this because it's going to end badly. And I've done that so many, and it's clearly not the right answer.
Chris, is it fair to say that it's almost a game of just stay one derivative ahead of the crowd? right?
Yes.
So if the crowd is doing 0th level thinking, you need to do the first derivative. If everyone is done now at the first derivative, you need to go to the second derivative. And so you don't
100%.
need to go to the limit. It's just always being that derivative further than the crowd.
Right, and you can call it derivative further. You can just say, like, you want to be one step. You want to predict where the crowd's going to be. You want to find out where the crowd's going. You want to get there early. That's the best. It sounds easy. It's obviously the challenge.
It's been a big challenge for me this year because I've said every time I say this is dumb when I look at what's going on in the markets, that was actually a great time to invest in whatever that is. Because I think there's a lot of 0th level thinking going on. And that's not an insult to what's happening. It's just I'm the one missing out on making money.
Yeah, I mean, you are wrong.
You're muted, Adam.
Yeah.
I was wondering, like, is it 0th level or is it like nth level, right? Like, it's like the person who guessed 20 when the answer was 20 was able to read the right level of the crowd. I know that's what you're saying, but it's...
His thinking was nth level, but his thinking of nth level was that, like, what is this group of people going to do, and how do I get in front of that?
Right. It's not what a rational player should do. It's what this group of people is likely to do.
100%.
And get there beforehand.
At peak GameStop mania, I had a friend text me who bought GameStop at 420, and he said, "I'm sure I'll lose money, but this is my middle finger to Wall Street." And I said, "Citadel is loving this." I said, "It's not a middle finger to Wall Street. You're just giving up your money." Right. And so, but to me, there's I'm not saying 0th level in a derogatory sense, but there's zero investment logic going on there. Right.
Right.
Well, there's no investment logic, but there is a human logic. Right. So I just listened to this podcast series from the CBC on what was that exchange that went under? Quadriga. And the two guys who founded that exchange started their money-making endeavors by creating Ponzi schemes in these online forums where other people participated in these Ponzi schemes, where it's like, send me this money and I will return X amount of money for you next week. I can't tell you my formula, but you're going to get that money. Everybody involved knew they were Ponzi schemes, but they were playing the human game. It was like gambling of, I think I can figure out when I'm not going to be the guy holding the bag.
It reminds me of the experiments
gaming that, right?
Remember Vernon Smith? I remember. He's got these videos from many. Yeah, exactly. So, he ran a lab for many years. I think it was at USC or one of the University of California, and he ran this lab where he performed experiments on originally students, but eventually like economists and floor traders and the CME and all kinds of things. And he had them play this market game, and we knew that. So the value of the asset was known at each point in time, but you could still trade around the value of the asset. So it was this sort of trading game, and there was a terminus, and you didn't know when the terminus was. But anyways, he played this game once, and this happened with every single group of traders. So he played the game the first time. The value of the asset declines through time, but the participants create a massive bubble, and then the bubble crashes at some point between sort of 1/3 and 2/3 until the terminus. So then they play a game with the same players, right? So have the players learn the lesson, and they do exactly the same thing. And they ask the players afterwards, you observed what happened the first time. Why did you do this again? They said, well, because I thought I could get in and out ahead of everybody else, right? Yep. And then on the third time, the effect began to moderate. But
that's why I feel a little bit sad for the GameStop crew. And you don't want to but at the end of the day, it's like this whole holder, obviously, this is the risk of this is that you get a bunch of people who don't really know what they're doing, and they've been told by everyone that if you never sell, if we all stay together forever, if you never sell. And it's like, but of course you have to sell at some point. This isn't going to pay you dividends that is going to make us money. You know how this game ends. You have to sell. And so really it's the sucker left holding the bag at the end of the day that goes, well, I thought we were all in this together, guys. And it turns out and of course you need those people. And so but this whole standing up and say, hey guys, we all do this together. It's like, it is a giant game of chicken, no doubt. Because if you're ever going to make money out of it, you've created a liquidity squeeze. It is going to come down very fast when it comes down. It's a giant game of chicken. It's a great fun game right now. But at the end of the day, it doesn't end well.
So I would argue the entire market is an example of this phenomenon at the moment. So, this is the CIO's dilemma. So, where do we go from here?
So, well, that's
how to put a guy on the spot.
Look,
just send them the wire instructions to your fund there, Chris. Just that's when you start saying Bank of America, Swift code.
It's going to be hard, and I don't know. Like, I don't know, because I look at this equity market and I go, really? Because I don't think it ends well from here. But no one wants bonds anymore, and I think I still believe a diversified risk parity process is absolutely the foundation of how you start investing. But no one wants bonds here, and that's a hard sell. And so what people might be looking for a little bit is like, what do I replace the bonds in my portfolio with? And you go, what? The answer is like, should be levered bonds. They should be in there. You should have some. You might want to have stops on it. You might want to have some protections in place to make sure that that you protect yourself. But at the end of the day, you probably want some of it there because there are still growth and deflation risks in the market. But you probably and this is what I was trying to get to last year, is you probably want a little bit less beta in general, because beta is pretty scary here. If you got less beta and you still want to make some returns, what do you do? Now, if I'm an investor, if I'm an allocator, I got a couple different stories here, but basically if I'm an allocator, I've got two different sources of alpha, right? I got my manager's alpha. I've also got my alpha. And what's my alpha as an allocator? My alpha as an allocator is finding good managers. So I'm going to call that manager selection alpha, portfolio construction alpha, putting them together well. Some managers might have edges over others, and your edges might be that you can trade quickly, or that you have a good mandate, or you have more capital. It might be that you have that you're less constrained, right? Because in any source of crowdedness, who's the constrained and unconstrained investor? There are some investors out there who have a mandate who can go into emerging managers, and some who can't. Emerging managers, academically proven, tend to outperform, and they tend to have high returns, and they tend to be more diversified because they tend to be a bit different. So that sounds like what you want in your portfolio, but at the same time, they're way harder to invest in because they're way more risky personally, right? It's so much easier to invest in the big name than it is to invest in the small guy. And it takes more risk. It takes more manager diligence. It takes more operational due diligence. There's a lot of extra work that goes into it. But if you're willing to get your hands dirty and do that extra work, you should be able to get some premium for it. And there's a small number of investors who can. And I would say whenever you have a competitive advantage over the rest of the universe, it behooves you to take advantage of it. So I think that's an opportunity for some alpha. I can talk about that a fair amount more. I also think as an allocator, putting managers together is a massively difficult problem, and also potentially a large source of alpha. So I'm looking at it going look, if you're a pension plan, you go, I build my beta well, and then I think about what alpha I can add. And whether that's internal alt risk premium or internal active management, some people may still consider private equity and credit and infrastructure active, but I think there's you have to make sure you separate out what are the betas and what are the liquidity premiums, and how much of it is active what's the value added from active management minus the cost, and so that you have to be careful with that. But let's say there's some of that as well, and so where do we get our liquid active management? Like I said, if you want to get that discount rate neutrality, you have to put a portfolio of managers together. And man, is that ever hard, right? It's hard to select good managers. It's hard to select good discretionary managers because you don't really know what they're going to do. You're buying into a thought process. It's very hard for many people to select good systematic managers because most allocators aren't familiar with the space, and B, the systematic guys, they all tend to sell and tell the same stories.
It's a really interesting conundrum in systematic, right? I mean, obviously, who's been the most successful systematic manager, right? I mean, I would argue maybe AQR,
right? AQR for themselves,
successful in raising money, or successful?
Oh yeah, no, I mean successful as a business, right?
Yeah. We're pretty happy, successful in happiness, resolve, asset management.
Okay, put a pin in that. Happiness. But I think there's a really interesting tension, right? Because one of the reasons why AQR I think grew to such a huge size is because they gave away their secret sauce, right? They published in very fine detail all of the techniques that they use to generate alpha, right? And it allowed allocators to wrap their head around it, to present rigor to their investment committees, to look at back tests and say, this is what I'm extrapolating into the future. But by virtue of doing that, it also meant that you allow every other systematic manager in the world to use exactly the same techniques to generate exactly the same return streams, including, to a very large degree, institutions like teachers, right? I mean, or a wide variety of other institutions who decided that they were going to build their own internal premia desks, right?
And so I'm a huge fan of the guys at AQR. I think they're awesome. I think they did some really I think they are still doing some cool stuff. I think they did some really cool stuff. I'm not sure that they shared as much as you think they shared. I think the stuff they were doing, but they were there's basically different types of alpha generators, right? There's the guys who are the grand collectors and diversifiers, and they were doing some cool stuff themselves. But they were more like gamers. Let's go academically. Let's collect all the different ideas out there, and let's try and portfolio construct all of them together. And that grand collection of ideas is an absolutely viable way to create alpha. The problem is that the things that you're collecting may be well known. I don't think AQR invented any of them. And so Chris Attis, I guess, he can talk a bit about some of the factors he worked on. But at the end of the day, I think what they did is they collected and put together a very good, large, diversified basket of stuff. But that stuff itself was already known. We didn't get our ideas from AQR. We were already running that basket when we we were already well built. And so I think at the end of the day, not like we invented them either. A lot of those things.
No, I think it's not the invention of them; it's the publication and mass distribution of them. I guess where I'm going is
I don't think so. To what
extent did that engender crowding? Right?
I wouldn't blame AQR for the crowding at all. I would say you can blame me. I may have told as many people as AQR about what I think is the right
bastard.
But obviously not as influential. But
it's like synchronous discovery. Is that what everybody's seen with the amount of access to data, amount of
the things that they were doing
distribution?
I would say many of the things AQRs were doing were collections of well-known risk premiums, and they may they wrote books about them, and so they may have helped a bit. But I think their success may have driven competition, and and because what they were doing was less a bunch of independent secret sauces and more of a grand collector, that could be probably replicated to a certain extent. I would say, look, every single strategy has its optimal AUM size, and so one of the challenges, because I get this question all the time, which is well, why would we invest in you when I can invest in DE Shaw or Two Sigma or they have 1,500 employees, they have 500 PhDs, and you go so how do you compete with them? And I think the question is look, you can do the alpha of collecting ideas, you can do the alpha of creating your own new ideas, and so what we really focused on is that we tried to build things that we think are truly different. And to that extent, they go, I'm not competing with a Bridgewater, with a DE Shaw, with an AQR, with a Two Sigma, not even close. And of course I'm not. I'd be crazy to compete directly head to head against them, because when you say what's competition, the competition is, if they make money, I lose money. If I lose money, they make money. We're taking each other's money. And I go, not even close. We're doing completely different things. We're not competing in any way. What I would say is that we're both partners in helping our institutional investors meet their return requirements. We're working together. We're almost partners working together because we are in no way competing. But that doesn't take away from the fact that I think we can be competitive. I think we can be a useful additional arrow in the quiver. But from that perspective, how do you get there? And you say, well, you have to be different. And so different is hard. And this is when I said the challenge of portfolio constructing. Okay, I'm going to throw you guys another quiz here. I have two independent managers, okay, or I've got a manager who's uncorrelated to me, and we know that if the correlation is 0, right, the diversification benefit is 1.4 times, right? It's the square root of 2. So my expected Sharpe ratio is 40% higher if I get two independent managers. Okay, how many 0.5 correlated managers do I need to have to get the same diversification benefit?
Four.
Okay, so 4 says 0.5 is halfway between 0 and 1, and that's that's an answer.
Well, that's an answer.
Thank you.
That's an answer.
You said
anyone else?
Well, not with a response like that.
That's right. I'm terrified.
Now I've anchored. Now I've anchored.
You've anchored at 4.
7.
7. Okay, good.
46.
Yep. Keep going.
2.
No, keep going higher.
Well,
it's got to be a lot. It's got to be a tremendous. Yeah, it's got to be a tremendous amount.
So this is crazy. I would say it's over 100. It takes more than 100 0.5 correlated managers to get to 1.4 times diversification. And the answer is it's infinitely many, because it asymptotically approaches.
That's right. It goes
so quite literally, you could find 1,000 0.5 correlated managers and not have got the benefit of one uncorrelated manager. And this is not intuitive. It's not obvious. Uncorrelated is very, very important. So so how do you keep your managers uncorrelated though? Because they don't want to be. because and this is the other major challenge, right? You're like, say, imagine you could find 10 uncorrelated managers, which is super, super, super hard. And the fact is, if they're uncorrelated, let's say they each have like that one cool little Sharpe ratio 0.5 alpha process that no one else has. And you go, that's what I want you to run. If I can find 10 uncorrelated managers, then those 10 guys are uncorrelated. The diversification benefit is going to be square root of 10, like almost three, like a bit more than 3 times. Right?
Now try holding 10 uncorrelated managers on your book as independent line items.
So yes, that's your first problem. But so you go I go okay, so I can have a Sharpe ratio of 1.5 if I can keep these guys uncorrelated. The problem is no manager wants to run a Sharpe ratio 0.5 process. It's bad business risk. That's you're going to blow up at some point. And so they want a higher Sharpe ratio. And they go, how do I get a higher Sharpe ratio? I put some other stuff in there. There's well-known stuff. There's lots of well-known stuff. But even if I just put and this is very interesting because this is you have a problem with your managers. You go if your managers just put a little bit of one beta, it's the S&P 500, it's bonds, it's vol selling, it's credit, it's trend following. You put a little bit of that in there. As a manager, your Sharpe ratio rises. Or if you put half your risk in something that's 0.5, and you get another point, your Sharpe ratio goes to 0.7, you get paid more. Your business risk is decreased, you're happier. If each manager just puts a little bit of beta in, a tiny amount, 0.2 here, 0.2 here, 20% of your risk, then at the portfolio level, my Sharpe ratio has come down significantly, and my beta has gone up significantly. In fact, if each manager just puts 20% of their risk in one beta only, I'm going to be 75% correlated to that beta at the portfolio level.
Which is what we saw nearly every active manager do over the last 10 years.
Exactly, because they're getting incentivized to, because investors don't understand how important uncorrelated is, and they don't properly reward it and defend it. And because at the end of the day, if I got 10 managers, I'm going to fire the one who does worst and keep the one who does best. I want to win when everyone wins. I want to lose when everyone loses. I don't want to lose when they're winning. I'm going to get fired. And so different is valuable and important, but it has to get rewarded right, and it has to get defended. But at the end of the day, why does this math work? And I like to say the beta bioaccumulates in your portfolio like mercury in a tuna, right? And the issue is alpha is by definition uncorrelated. So when you put them together, the risk decreases, and so the amount of risk in your alpha decreases. But if you put that beta in, it's the same beta, and so the beta adds. And so if you look at your portfolio of 10 managers, the beta stays this. The beta adds up, and the alpha disappears, and the portfolio just becomes more and more beta. And say I'm paying fees. My Sharpe ratio of my portfolio is almost cut in half. I'm paying way more in fees. I have less alpha, and I'm 80% correlated to my beta. What the hell went wrong? It's all it took was just a little bit. And by the way, it's never a little bit, right? And so it's hard. You have a massive conflict of interest. And so uncorrelated for managers is really hard. And you have another big problem with portfolio managers is that you never get as much vol as you want, right? Because you go if I've got, imagine you could do it. Imagine you could find 10 uncorrelated managers and convince them to only run their Sharpe ratio half. Which is, by the way, going to be a very hard sell, but you do it. You convince them. I'm never going to fire you. Whatever. Off we go. And you put them together. And you go, okay, and they're all running 10 to 15 vol. Let's just say 10 vol to make the math easy. Then at the portfolio level, you only have 3% volatility.
That's right. With a Sharpe ratio of what?
1.5. If you
1.5, right? So
right, but
low single-digit returns.
You're making your 5% return, and you've cut your risk. And you go I was trying to replace equities in my portfolio, and I put it, and why don't you guys take more risk? And you go I don't want to take more than 50% risk on a Sharpe ratio half. And you go, that's the problem. And so now you've got this issue where your volatility is too low, your return on cash is bad. Oh, and you've got a massive fee problem. Because it turns out when you do that as well, you have two major issues. When you put 10 of these managers together and you're paying them each, let's just make the math easy once again. You're paying them 2 and 20 because I'm convincing you to just run the Sharpe ratio half. I pay you 2 and 20. And at the portfolio level, you end up paying 65% of the returns away in fees. Well, why is that? Well, because there's I can run through the math at some point, but it's just take my word for it for a second. And so that's a massive problem. I go man, my fees are too high. Even if I've solved the portfolio construction problem, I'm paying way more in fees than I want to. My return on cash is terrible. My volatility is too low. What's gone wrong? And so if you think about the other side of it, if you had 10 uncorrelated managers, right? Each of a Sharpe ratio half, but imagine they're all under one shop. They're all under one hood, right? Because those first 10, you have a basket of call options instead of a call option on a basket, right? If the managers had no skill at all, if you screwed up, they weren't Sharpe ratio half, they were Sharpe ratio 0. They had no skill. At the end of the year, 5 are up and 5 are down. and you're paying performance fee to these guys, and you don't get it back from these guys. So you're ending up paying 80 basis points a year on expectation in performance fees for no skill, right? Whereas if you put them all together, the 5 go up and the 5 go down, there's nothing there. You pay no performance fee. And so that's a big difference. But like that's actually not the main difference. The other big difference is that 2% management fee, because you're paying management fee per unit of vol. I'm buying 10% vol with 2% management fee.
That's right.
Okay, I put those guys together at my portfolio level. I'm paying 2% management fee for 3% vol. Well, that's not great. If you had those 10 managers under one hood, and you were running that thing at 10% vol, that's like each of those managers running at 31% vol, because that 31% vol diversifies down to 10, and you're charging 2 and 20 for that. It's 1/6 the fees. It's 1/6 the return on cash. It's half the fees. And so like it goes without saying that a multi-strat where you put the fees together is an extremely fee and balance sheet efficient way of doing it. If you can get managers to cross, but discretionary managers never want to do that. If I make money, I want to get paid. If I lose money, I want to get paid. Systematic models, they don't care. And so like 10 or 20 independent systematic processes under one hood is extraordinarily efficient from a whole ton of reasons. And it also solves those portfolio construction problems, right? Because the manager who wants a cheap beta in, if you've got 10 models under one hood, you're not going to put a little beta in each one of them and drive the Sharpe ratio down. Why the hell would you do that? So the thing you've taken where you were against your manager, where you had the opposite utility of them, and suddenly you're aligned because your manager is portfolio constructing on your behalf, not on their behalf. And so those beta games disappear. A whole bunch of other utilities disappear. So I would say like from a portfolio constructing managers is hard, but to the extent that you can find managers with multiple processes under one hood, that is it's a significant reduction from a
This is an incredible point when talking about multi-strategy quantitative managers. Is I don't even like to say that like we have a strategy. I like to say we have a bunch of virtual managers under the hood. Yep. And within we have a bunch of silos that seem to be similar, but even within those silos, we have a bunch of managers that are slightly different trend and momentum managers or whatever. And you're using the efficiency where we're not even trading those independently. We are creating signals, we're aggregating the signals and making one trade for all of them, which is another thing that is really difficult to do when dealing with discretionary managers or independent managers, even if you're using them under a single platform. Right, because you can't necessarily, or you won't get cooperation. And then each one of those independent quantitative virtual managers are not running at, let's say we're targeting 10 vol. We're not running them at 10 vol each. We're running them at 30, 40 vol, but when put together, they target 10. And it goes on and on and on and on like that, right? The efficiency of that.
There's all sorts of other I wrote a little white paper on this, and it was one of those little toss-ups I gave to presentations at the end. Because I thought it was fairly obvious, but it turns out like it was pretty well received. But there's I forgot what I was going to say. I lost my train of thought.
Sorry, I interrupted.
This is an endlessly fascinating thought, the path to go down. And I love this idea of a basket of call options versus a call on a basket. I wonder, it makes a tremendous amount of intuitive sense. I can see why hedge funds wouldn't want to do it from a business perspective, but I also go back to the knockout risk of leverage itself, right? That asking a manager to operate at a higher degree of leverage, which might be good for you, might be inherently bad for the manager. So does it make sense, say, at the allocator level to then say, okay, we're going to lever our book and just allocate more capital to the managers rather than asking the managers to take that leverage risk?
It totally would. So look, mathematically identical. I can give you $50 million at 20 vol or $100 million at 10 vol. Like obviously there's a geometric drain difference, but call it like very, very similar. If I want more exposure, I can just give you more.
Well, you're paying more fees though then too, right?
Well, it depends. Technically, the correct fee adjusts for the volatility. I would say, you should always adjust your fees for vol. If someone's charging 2 and 20 for 20 vol, they should be charging 1 and 10 for 10 vol. They should be charging a half and 20. Sorry,
100%. That's exactly how we price. But I've yet to see anyone else price the same way.
Well, no, I went to conferences where I had managers that had 2 processes with the same fee structure, 1 and a half the vol, and you go, who in their right mind would buy the second one? It's twice as expensive.
And the answer is everyone.
They go, lots of people.
The answer is everyone. Yeah.
People don't want 20 vol, they want 10 vol because they can go to bed at night and not worry about it.
I've had the exact same conversation with Cliff, right? Why don't you run this hotter? Because nobody wants it hotter.
Yeah,
but it's so inefficient. I know, but people don't want efficiency.
But you've got to be clear. Like people have like their own personal sense of loss. They also have like their boards. And so like, look, if you're a manager, and I know no matter what happens, if I go down 15%, you're going to fire me. I'm never going to let myself go down 15%. Right? And there's a significant cost to that. There's massive cost to firing you when I'm down. Look, once again, let's talk about our Sharpe ratio half managers for a second. Imagine you had 10 Sharpe ratio half managers, and you had a rule that says when they lose 15%, I'm going to fire them. And they don't play games. They just run their constant 10% vol the entire time. After 10 years, you're going to have fired 14 managers. Yeah. Just on noise. The skill hasn't changed. Nothing has changed. You're because you should expect peak to troughs of 15% frequently if they're not hiding their risk in higher moment risk. If they're properly, which you want a manager to do. You don't want a manager to make money 9 out of 10 and lose 8 years worth of money a year. You want proper random walk. And if they do that and you fire them, they go. So what they will do. So that's a terrible game because when you fire managers early, that costs you a ton of money. It costs you 50 to 80 basis points to fire a manager early. Why? Because nothing has changed. There's still a Sharpe ratio half. You're going to replace them with another Sharpe ratio half. But what you have is when you fire them is you left the underwater curve behind. Like you left the high water mark. And so and that on average is a drain. And this is assuming you could with zero friction fire that manager and replace them with an equally good one, an equally independent 0.5 that you have apparently a staple of them the next day, which you can't. But if you could even the fact is you leave 50 to 80 basis points. So it's should I pay you 2 and 20 or 1.2 and 20? You argue that endlessly. But if you fire them early, you're costing yourself that. If that's your process,
you can't ask the new manager to reset his high watermark to what you just had.
No, of course not. So you leave that behind. That's your first one. Your second one, if your manager knows he's going to get fired and he does play games, then he'll start self-optionalizing. This is also very costly for an investor, right? For an allocator. And you look at it, the self-optionalization is, look, it's very, very, very hard to force a discretionary manager to take risk when they don't want to. We had this, in our group of teachers at TAA. It's because managers will play games, right? And they'll say, I don't see the opportunity right now. You cannot make me take risk when I don't see the opportunity. And so there's a utility conflict because it may be December and they want to shut risk down. It may be they're underwater a bit and they don't want to take risk. But if a good trade idea comes along as an allocator, I want you to take that trade, whether you're up 10% or down 10%, whether it's January or whether it's December. That's what's right for my portfolio. But you're going and so that's a real challenge. You cannot make a discretionary guy take risk. But and so when a manager self-optionalizes, well, I'm paying you 2 and 20 for your Sharpe ratio half at 10% vol, and you cut your risk in half because you're down 7%. Well, now I'm paying 2 and 20 for 5% vol, and so if you think about it, a 10% vol with let's say there's a Sharpe ratio half, they're making 5% and 2% go away to management fees. When they cut the risk in half, Sharpe ratio half, suddenly there's nothing, there's only 50 basis points left after management fee. So when managers self-optionalize, not only do you lose your diversification benefit, I had 10 independent 0.5s and now I don't, that costs you, but also I'm paying double the management fee at the time. And so that costs another 50 to 60 basis points a year. And so when you look at it, you go these are little small things and you start to see how they add up in a portfolio. And I haven't even talked about how hard it is to find independent 0.5s. But to understand, there are a bunch of behavioral challenges as an allocator that introduce these incredible headwinds, and oftentimes they're not you. There's your board member goes, well, you have to fire someone that's down 50%. Long story short, to bring it full circle, there is very few managers who go, I'll run 30 vol, because of course, unless you go, we're cool with you losing 50. What is it at a 0.5 Sharpe? What is the probability of a 50% drawdown? Right. It's massive.
At what vol?
At
10 vol. 30 vol, sorry, which is the example I was giving, right?
I wouldn't say it's that high. So you think of the S&P as a 0.5 and it does 50 all the time, but the key feature of the S&P is it's got non-constant volatility. So it gets to those 50% drawdowns because it does it at 30 or 40% vol when it's going horrendous. You call that a 5 sigma pull over the course of a year. Not super likely if they're properly normal and random walking. But you're right. I think the 1.5 sigma pulls will happen every 2 to 3 years, and that's 15%. And so you're firing people on what you. And so this is the other thing. And we are now in this we're 6 weeks in, and we have entered the roller coaster, right? Because this is it's unfortunate because you wish that this isn't the way it goes. But you
mean your strategy?
Our
6 weeks into your strategy.
Yeah. 6 weeks into our strategy of live trading, and you go, this is it's tricky because your process, if you're trying to get a Sharpe ratio of 1, right, you're expecting to make 4 basis points a day, right? 4 basis points a day is nothing, right? But your market volatility is 70 basis points a day, 1 standard deviation, or on bad days it's 2 times that, like once a month, and so that's 140, 150 basis points you should expect to lose once a month at least, and you go and so you get a couple of those. And it is not a statement about the alpha process. It is simply a statement about risk. Market risk comes, it's ferocious, it's noisy, and it takes a very, very long time for the process to prove itself. And so, it's just as hard to create a minus Sharpe 1 process as it is to create a Sharpe 1 process. If you have no alpha, you should expect to decay towards 0, right? Unless you're churning. But if your turnover isn't crazy in massive degree, a -1 is just as hard as a +1. A -2 is just as hard as a +2. 0 alpha is 0 returns. Anything negative and Sharpe is a market event, is market risk, is liquidity risk, has nothing to do with the process. But it's very, very hard as an allocator to extract yourself from that statement because it's hard to see past the noise.
So you were acting in an allocator role for many years, right? So how did you introduce any sort of decision-making frameworks to make the best of your managers and maximize the chances you were going to get the most out of your allocations? And then at the broader portfolio level, any sort of decision-making frameworks to get the best out of your team internally?
Oh, yeah. Okay. So out of managers, first of all, look, if you tell your managers you're going to fire when they're down 10%, you've introduced so many moral hazards against yourself. You have just punished yourself with that statement. And you should expect to say that at 10% fall, maybe it's 20, maybe it's 30, but at what point do you challenge the alpha statement? I'm not sure, because once again, really big drawdowns have nothing to do with alpha. They are a risk statement. And whether that's now, if your manager screwed up the risk statement somehow, they went, we are going to do risk this way, and they didn't, that is a strong conversation. If it happened because something happened in the market, in March of last year, no one screwed up their risk. An incredibly, almost impossible to predict and very hard to respond to market event happened very, very quickly. You either had a great 2 weeks or a terrible 2 weeks, but there was very little in between. That is less a statement about you and your risk statement than it is a statement about man, every now and then the markets are insane. But if you feel like the manager screwed up their risk, that's that is a very significant conversation for me. So risk, portfolio construction, model building philosophy, style drip, I'm very, very serious about that because I'm really focused on what you're contributing to my portfolio. The way that you can stick with a manager when they do badly is if you actually get to know them as people and get confident and comfortable with their intellectual thought process. Once again, very, very hard with systematic investing because systematic investors cannot give away their code and their secret sauce because then it becomes useless. So at the end of the day, it's you have to get comfortable with them as people and their thought process. And so we would dig into model building philosophy, portfolio construction philosophy, thoughts about parameterization, how do you think about building the model and how do you think about doing it? And then I've got your correlations to know if you're doing something different from me. To what you're willing to tell me about thought process, I can get more comfortable with it. But it's the managers who you never really there's always there's a couple of yellow flags that when they lose money, you go, I don't know what to do now. You feel conflicted. And this is once again inherently a challenge of systematic investing because the discretionary guy who told you a story about why they do what they do, he's if it didn't work out, you're but I got the story. And in fact, if they're still holding on to it, oftentimes they go, well, this thing got cheaper. It's even better now. I lost money and I like it more. You're never going to see someone go, hey, the systematic investor lost money and I like it more. And so that's a difficulty in the space. But at the same time, look, Quant has had a really rough couple of years. A lot of factors have a rough couple of years because Corey, as you're talking about, that imbalance was going this way. The key feature of these guys is they have to be here. They don't get to leave this process. They don't get to leave their constrained box. It's just these guys who get to decide if they want to be there or not. And if too many of them come to here, they're going to go, no, this is no longer a game I want to play. It will come back down. It has to. These guys will always be here. These guys will self-equilibrate at some point to the point where there's a decent return on risk. Otherwise, they'll keep leaving. And so look, the grand diversifier here who does this most efficiently and the best is still going to, it will return. Quant will absolutely make a comeback. It may never be as good as it was in 2005. It will never be as good as it was in 2005. But it will be good. It'll be useful.
The Sharpe ratio will be lower than what you saw when it was less crowded, but there will be a positive Sharpe ratio given the inefficiencies that we see.
It has to return to that.
Various arbitrage.
And I would say, look, nothing right now is going to be as good as it was in 2005. Good luck buying infrastructure today at 2005 prices or real estate or equities or
private
like,
equity, anything.
or anything.
Yeah.
Like everything is expensive and crowded. And so like I think that's it's everyone's problem. But yeah.
So Chris, I want to go back to continue on that thread of decision making, because the way you were answering that question is managers, decisions that they make. But we had a conversation offline about, we just had Annie Duke. We're just talking about how do you create within a large organization a better decision making process. And I would love for you to tell a story about the framework that you and the team came up with, and then what the consequence of putting that framework together was.
Sure. So, when I guess at the end of 2015, when they created this new group, portfolio construction group of teachers, and I was head of asset allocation and portfolio management, which ultimately was responsible for and we were trying to figure out, well, we're gonna try rethink total fund portfolio construction, everything to do with asset mix, stock, bond, commodity, factor exposure, like hedging, alpha, beta, liquid. And active budgets to the departments, and we have to think about this. And at the end of the day, we kind of went look, how? And this was just my thought process. Was how? There's so many incredibly smart people at teachers, and right now, at my very first committee meeting, and you had all these committee meetings, and this is just kind of the way a bunch of investors will tend to get together. Here's how a typical committee meeting goes: is that it's like an FX committee or an EM committee, and they get together, and someone promotes pitches something, and there's 15 people in the room, because there's a lot of people want to get involved in total fund, which is fantastic, because it's great that people are wanting to get involved and want to contribute. And so you have 15 people in the room, and someone pitches something. There's a bit of discussion, some questions are asked, and then there's a vote. And I just couldn't help but think, I read Tetlock's book. I thought about it a bit, and I was I couldn't help but think there's got to be a better way, because there's a lot of problems with this. Because the first time we put something on, 15 people voted, we all approved it, but who owned the risk? It's well, that was me. I was the throat to choke on that decision at the end of the day, and I went well, we've got to think about this a little bit, because here's a bunch of the challenges. I got 15 people in the room, but maybe I only heard from 2 or 3 people. And whenever you have a bunch of people together, it's the noisiest person, which is me most of the time. But it's the noisiest person, it's the loudest person, it's seniority. What did the boss say? And so there's a real art to collecting the independent views without contaminating them, right? So that's the first thing. The second thing is accountability and ownership. Who owned it? People put this trade on, but at the end of the day, if it went south, there was a whole bunch of duck and cover, right? And so because he didn't actually own it, and didn't feel a sense of ownership and accountability. And then the third thing is how do you get off it? When do you end it? What's the process for that? How timely is that? Do you have these meetings every 2 weeks, and every 2 weeks you go, are we still good with this or not? And so I was thinking there's got to be a better way. And so the way I thought about it was can we capture this information in a timely manner with accountability and oversight and alignment? And so what we spent a lot of time sort of thinking about and working towards was a framework. It's what happens if we put a trading game on people's PC, right? And this trading game you had a bunch of assets that you could buy or sell. And if someone pitched a trade, you could add that as an asset. And basically everyone then could and say, do I want to buy this or not? So you own it. But here's what had to happen for it to work. You had to have some sense of responsibility and accountability, and you had to care. So I said, people have to get paid on this. You're asking people to take a risk and to put their hand up and contribute to the total fund. But if they went, we should buy stocks versus bonds, or we should buy IG versus high yield, or those trades, can we wait to put them into a system where someone owns that as a bet, but we're not actually putting the bet on? Because this is the problem. Because if a bunch of people like credit and a bunch of people like equities, they go maybe I've got too much equity factor at the fund. I don't necessarily want that exposure on. I want to put that into a portfolio construction framework and think about what. But I have the information captured. But the key feature is this: if 1.5 days in, someone is like, we should be long energy here. When I don't like crude anymore, they sell it. I have real time, instantaneous feedback of what the person actually believes.
High quality information.
You may not
use
that I would never get,
and independent.
Cost you some money.
Timely, independent, and so this is I felt this is the way to capture all of this, really market knowledge in the fund. And who wants to put their hand up and play? And a bunch of people did, and it was juniors, and there's a couple problems came up though, which was we couldn't comp people differently. That's an entire HR discussion, and but hopefully they get involved anyway, just because it's their job. But a lot of people went risky and no benefit, maybe not, but a bunch of people still did. The second question was, is it anonymous or not? What happens if I look like an idiot because I got it completely wrong? What happens if I went against my boss and I got it right and he got it wrong, or vice versa? So the question is, do you make it anonymous or not? And that becomes yes, you could, and then maybe not. And you could maybe anyone who wants to can play. Do you let people in back office or in finance play? sure, I guess, because we're taking these signals in. We can weight them however we want. You're capturing information. Like maybe ideas come from anywhere. But really, like, if I
in a
was
weird way, aren't you also risking just giving them a free call option if you're going to compensate them on the upside but not penalize them for making bad calls? Like, unless their job is going to be on the line, it's like, why wouldn't I just gamble on high risk plays?
Isn't that just investing at a pension plan, though? I mean, like, I'm going to get in trouble for saying that.
You tell me.
Anyway, but like, to take it away, you say, like, so you take the high risk ones. That was an exact part of it. It's like, well, wouldn't I just take the most volatile thing? It's like, well, of course, I don't want you to do that. So I'm going to like give you the unit that you're buying is a vol targeted unit. Because I don't want you just to play a high vol versus low. Because yes, you would then take the highest vol thing you could and expect on expectation to get paid out. So vol unit targeted, which is a little bit difficult to explain. I don't want you to bet on 100 things. I'm not looking for your portfolio construction. I'm looking for your ideas. So limited number of trades. I don't want the high frequency in and out everyday signals. I want the long-term hold. So we had to charge like a significant enough bid ask to make it, you know. And so yeah, we thought through like a lot of these challenges and a lot of these problems. And ultimately we I think we like it didn't really fly. And I think that the main challenge, like, and there was a bunch of challenges, like I said, there's compensation challenges, there's getting people involved challenges, but like there was also a lot of pushback from senior team kind of going like, this is my job. Like, I'm the guy. We're the people making these calls. I don't want to have to do what they tell me to do. This is my job. And I think like it was just funny because like I heard Andy Duke say the exact same. I was sitting there nodding, like he goes like, it turns out like these betting processes, if you can make them independent and anonymous, you can collect the information. And I think this was even better because it was real time and properly accountable. But if you can do that, it does tend to do very well. But the issue is challenges in org structure and a sense of authority and a sense of delegated responsibility. And some people are going like, well, why wouldn't you just like give us the money, we'll trade it in our book? And it's like, well, because I don't know what we want to do at the portfolio level. We're capturing information, not necessarily responding like, you know. Anyway, it was a very, I thought it was really cool. I believe the software is still somewhere over there, but like I'm not sure it's being used. So
what's odd about it is that it is a tool to help the people higher up to make better decisions that will ultimately help their careers, right? It's just so short-sighted to be like, no. It's not about proper decision making. It's about ego. That's all I see. Because you wanted it. You were up there. You were going to use it.
I'm not sure it's about. I mean, like I'm.
Well, I know they're probably here watching. I'm sorry, Chris.
I think I get that there were a lot of difficulties with it that were institutionally challenging. I think is the way to say it. But like I still think it's a very, very useful idea. If anyone said like this is something we could do in our institution to capture this information, like, you know, there was also a little bit like, why not put it on the dealer's desk and let them contribute as well to like, you know, but you know, like people even like kind of raised like, well, what about the conflict of interest? You're paying me and I could be long credit here. Like, can I build a long short arb in my book? And it was like, you know, it gets very complicated when you get smart people thinking their way through like independently paid.
The best thing is that you've got this process which hits all of the major, like ticks all the boxes in terms of optimal decision making, right? You're taking the best ideas from Tetlock and the best ideas from Andy Duke and all the best decision making, best practices. You put it all together. You've got a really good system, and those in charge hate it because it compromises their position at the firm, and it's not at all unique to teachers. I'm sure that if you apply the same process,
strong, but it wasn't successful.
Right, sure. But if you apply this anywhere, you'd run into the same organizational frictions, right? It's like you've got these fiefdoms. Everyone needs to justify their jobs and justify their incomes. And so it's not just that you've got to have a great decision-making process. You've got to have a great decision-making process that also is aligned with the incentives and the structure of the organization, right? So all of these pieces need to fit together and flow.
Well, look, I'm not like there's basically two types of institutional decision-making frameworks. Like there's literally like, can I collect the information and pull it up, or is it command down? Like, here's like, help me make a decision. I'm going to make a decision, then you're going to implement it, or I'm trying to draw advice up. I'm a big draw advice up fan, but I totally respect that there's another side to that. And I've heard it argued very well many times as well, which is the command down. So
let me make sure that we sort of wrap this conversation up with something. There's been a huge amount of really interesting content, but like something super practical, right? So circling back to sort of the CIO's dilemma, and we recognize, I think, you know, you stated, we certainly agree, the most optimal.
I'm sorry to interrupt you. Can you give me 1 minute? I'm totally sorry. I'll be back in 1 minute.
Yeah, of course. You bet.
Well, look, I just
when the guest leaves,
I just want to
what do
say
you do?
he should have gone to the bathroom before he started the podcast. I told him 5 times. It's like my child. So the one thing that I think is important here, because we get this question all the time, as to, well, why, you're a quant, I want to know the exact rules that you use, and then when you use them, I want to make sure that you're going to continue to use those rules, which is what all these ETFs are, right? Rules-based decision-making, index, create an index, create a back test, promise the back test, execute, you go flatline for a bunch of years. Those are seen in the same light as quantitative investors like us that are constantly trying to evolve and improve and move away from the crowd, and they're not the same thing.
No,
but I think that's an important distinction, and we've been grouped into the same class. But we're really active managers using quants and rules in order to be able to provide pure alpha over time, right?
Everything in the investment distribution process makes it difficult for systematic investors to innovate, right? You've got to describe your strategy in great detail in the prospectus and in the fact sheets. Anytime you add new markets or new information sources, you need to amend the prospectus. Like, it's everything, at the index ETF level, if you make changes or you're jeopardizing your passive index status and it's got maybe potential tax consequences, like there's all of these incredible obstacles, which is why there's a trade-off between access and the likelihood of success, right? If something is if you have access to it and you're not an accredited investor with a high level of sophistication, it is much more challenging for the manager of that product to deliver consistent innovation and consistently improve their product because of all the headaches and major regulatory obstacles that there are in front of them as a process.
The ETF is difficult for sure. Yep.
I was just going to say, it almost raises the question of why bother calling yourself a systematic investor anymore? Just call yourself a quantitative investor.
Yeah.
Right? I don't know what's a dirtier word. I got to be honest, because when you say quant, people think equity quant. Systematic models. I would just say, like, at some point, like wouldn't the best thing to be like have some signals, help make some decisions, and just like literally then go and then discretionarily.
You're an active manager.
Yeah.
You're an active manager that uses coding in order to be able to execute every aspect of that process.
But I hate this term, but there's this quantamental term, which is that mixture of quant.
We just had, like, our head trader just threw up on the screen right now.
But I do see that a lot in like the volatility space where they're quantitative investors, but they're not systematic, right? Yeah. And they do draw that distinction. And again, I think we put ourselves in a corner.
I believe in the discipline of systematic investing so much. I do believe in the discipline of the vol targeting, of the portfolio construction. Like, I could not come close to doing what we're doing. 20 ideas, each of which has like thousands of subparameters, and like you cannot do that. It is.
But that's not. I would argue it's not systematic because you're going to evolve it over time. It's quantitative. You are quantitatively enabled. Yes, you're using.
But the day-to-day decision making is systematic.
There's boundaries between correlation, what you can do with correlations and volatilities, though, right? And in order to understand correlations, you can't do it by gut. It is so complex. It's so multidimensional and ethereal. Like it's three-dimensional in a way that you just
you use quantitative models.
Okay. Yeah, look. We've had this exact discussion because at the end of the day, there's a taint right now on some terminology, and it's very interesting because people ask you, like, they still want to put you in a box. So what do you like? What are you? What box are you in? Like, are you trend? Are you convex or are you mean reversion or are you? It's like, well, no. And they go, well, you got to be one or the other. It's like, well, no. Well, then you must have switching. Well, yes, of course we do. It's like, well, then what? It's like, and it becomes a very challenging set of questions because they want to know what box you're in. And I go, like, look at my correlations. If I'm correlated to anything, put me in that box. But I'm pretty sure everyone I've ever sent my correlations to have gone like my returns are going, this doesn't look like anything else that we have. And I'm pretty sure it's pretty unique and pretty different. And from that perspective, it's very hard to think what box I belong in because a box shouldn't be a name. And this is why, like how do you compete with an AQR or two signals? So why am I? Like, is it because you literally say because you have you both have like a quant or systematic in the name? Because like there's a universe of difference in the way different people will approach different problems. Like at the end of the day, correlations where the rubber hits the road on whether you're doing the same thing or not. And so like at the end of it, different is different. Like and whatever tools at your disposal to get there. Like at the end, like different comes not on the technology use, but from the creativity that you have to get there. And so like okay, I got another story. I know you guys are like, you're gonna get tired of me very soon, but like there's like Michael Malduza like has this like I love his stuff and he there's like what do you need in terms of creativity, because like I love this analogy. It goes like ants, right? Like ants when they wander off and they do this, like they wander around, and when they find food they follow their pheromone trail back, and they lay down more pheromones, and they harden this trail, and the other ants start following the trail, and you get this line of ants. And they go, it's a very efficient process. It's a very efficient search process, because like once the food is found, like all the ants have a straight line to that food. And the crazy thing is, about 10% of ants, they don't follow that line. At some point they go, I'm going this way, and they wander off. And the thing is, like, it's so important to have the ant who's wandering off the line, because if you don't, they all follow the line, and at some point the food runs out. Like, it turns out it's a very efficient, hairy search process where like a lot of those ants who wander off, they don't find anything, but you need the ants who at some point in the line go like, I don't want to follow this line anymore. I want to do something different, because that's how you stop following the line. And the worst case scenario is called a death spiral. The ants will like start following each other in a circle. And like literally all the ants are following each other, and they go in the circle, and they keep going in the circle until they literally like starve to death. It's like
Chris, I'll one up your sorry, not the one up
your institution to get into the death spiral.
I'll add a little color to your story there. It's not just 10%. The more uncertain the terrain, the greater the number of ants that peel off.
I read a study today, so I was trying to catch up on it, and it's like different ants have a different propensity to peeling off. But yeah, like that's exactly and I find that so cool, because it's like, yes, this is exactly what you need. Like you need like the annoying idiots who challenge status quo. Because like as frustrating and annoying as they are, but you have to, and so this is where it's like, cross discipline is so helpful from this perspective, because like I think you can challenge the status quo a lot if you come from the outside in. If you're trained in a certain way of thinking, like I think already you're kind of caught in the rut to a certain degree, and like I don't know, I have that trend following. We talked about
the trend following.
I mean, this is like. This is like where I just think
I was coming at the trend following story. I was coming at it circuitously. So I was.
We're going like straight at 2 hours here.
I asked you before about the CIO's dilemma, right? So I was going to go into. So you sort of start with global risk parity, right, as kind of the core, and then you scale it to the appropriate level of all, which has its own problems, right, which we've discussed, and then you bolt on some alts. So. What are the alts that have the greatest propensity to scale well? Like what can virtually every institution bolt on? And then like let's sort of go down the capacity spiral, right? So let's start bolting on different potential sleeves of alts, and then see if we can put a viable kind of portfolio framework together for CIOs here.
Sure. So I feel like we led each other by the nose to this one, but like obviously I think the first and most important one is trend following. Like it's got a ton of features that I think over time make it very advantageous. And one of them is it's like, look, like when we first launched our CTA at Teachers in 2004, 2005, trend following was like out of fashion. By 2007, I think we fired all of our trend followers like externally, and we were like still arguing that this is important. And 2008 comes along, and I was like, man, you wish you had more trend following.
So hold on, I just want to make sure that we stop and describe what you mean by trend following, because there's a meaningful proportion of the people that are listening who think trend following is, timing the S&P, right? So that's not what we're describing. We're talking about, 60, 70, 80 markets, long, short, trend following with risk management and appropriate portfolio construction, like
right when
high quality diversified CTA type strategy.
That's right. When I say CTA, and probably like now it's like pretty well understood that you have to risk target properly. You have to have an ensemble approach. You probably have to have multiple parameters, probably multiple techniques, and so I think it's like I think like trend following is probably done pretty well right now as a thing, and it got crowded too. Like everything got kind of crowded, but at the same time, like. Well, I mean, it didn't do well for quite a while. People started to pull out of it, and it's literally in the middle of its like best 6 months. Well, 2014 was amazing because it got crowded, but every now and then you wish you had some more trend following. But there's like other aspects to it that I really like. Like trend following, you can think of it as you take trend following and slap it onto risk parity, and now you have enhanced risk parity. You have risk parity with stops. Well, that looks good. If you ever want to like build like a nice back test, go long and out stocks and bonds, and then get long short commodities, and that makes yourself look better. And because trend following has been around for 30 or 40 years, and it's the original risk parity. Like risk parity is a pretty new concept, but like trend following was equal weight by volatility, stocks, bonds, commodities, FX, and you put that thing together, and you go and hey, the other thing about trend following is it tends to sit along the risk premium side of things. Like trends, if things tend to go up, trends tend to follow it, and you stop out when it's falling. Well, you call that a risk reduction if you want. Not even an alpha call. It's like pull out when it's not doing well. You can scale the amount of that you want. And now you have a long process with vol targeting and some stops. You go, that actually helps a ton. And so like trend following is just so naturally complementary to the typical institutional portfolio. And man, if anyone's lacking something in their portfolio right now, it's probably commodity exposure. Oh, I know the commodities have been like the terrible child of the last 2 days. But just to say but over time, trend following
draw on this piece of paper where commodities hurt you.
They hurt me and then they help me. But at the end of the day, but if you look at trend following, you go what is it? It's inflation risk is a very, very significant risk to everyone's institutional portfolio, because inflation still hits stocks and bonds, and everyone's got stocks and bonds, and so what trend following doesn't cover all sorts of inflation. I know we talked about this last time. We said we kind of went, what is inflation? There is no. Is it monetary inflation? Is it CPI? Is it commodity price inflation? Is it demand side? Is it wartime supply inflation? Like at the end of the day, is it COVID supply chain inflation? We have lots of different definitions of inflation, and there's not really necessarily one way to capture it. And so we went we don't know how to cover inflation, so we're going to build a basket of things to try and capture it. So it's going to be a mixture of tips of break evens, which is a kind of real return bond over a nominal bond. Commodities, gold. Different ways that you can think about trying to capture this, because we don't care about inflation per se. Really, what you care about is that that unexpected changes of inflation. Let me get that. I keep getting this wrong. Changes in expectation of inflation is what moves the price of assets, right? And this is key. Once again, it's what people think. It's how people change their views relative to what their views were before that moves prices of things. And so when people have an expectation of inflation, they change their expectation of inflation due to whatever, the news of the Fed or whatever is going on, they will respond. And the problem is when you expect inflation to be higher, the implications are pretty bad for most of the assets in your portfolio. And whether it's because the assets themselves, that everyone goes equity is a real price. It's everything on this planet is real priced. If something didn't have a real pricing power, it would go to zero, because inflation goes up over time. Every single asset on the planet is real pricing. The question is, does it tend to make more money or less money when you have an inflationary shock? And in that case, there's very few things that are inflation hedges. Mm-hmm. And so a tip, a one-year bond. A one-year bond is an incredible inflation hedge from one perspective, because you go inflation comes in higher than expected. Next year, what does it do? It does its absolute best to price itself at exactly the price it needs to respond to that inflation that just happened. Nothing responds faster to inflation than a one-year bond. It is literally the best. You go an equity is not even that. An equity is a series of cash flows. And equity is imagine you have a series of one-year cash flows, a series of one-year bonds, one-year bond forward. And you go what happens at inflation? Well, inflation, you lose money in that first year, you do with a one-year bond. But then because it turns out you had a cost shock, and it takes some while for you can pass it on, and you try and raise the price, but then people are going to buy less, and so you take a bit of a hit. But the expectation is you can get it back over time. Well, guess what? If you do a rolled process of one-year bonds, you take a hit in your first year, but your next year's pay you back. It's a very, very similar concept. Everything is real priced. Real estate's everything is. And so the real question is, how quickly does it respond to an inflation shock? And the problem is most things respond negatively at first, and then over time will catch up. Commodities, if the inflation shock comes from the commodities, are obviously a very, very strong natural hedge.
It's a direct
inflation shock.
It's direct.
Also, with the financialization of commodities, it ends up being a preemptive hedge, right? Capital flows to commodities in anticipation of the potential of an inflation shock, and that actually may end up creating. Yeah.
Could absolutely. So and maybe it gets ahead of itself and has to come back a bit because obviously we've had some big moves in commodities recently. But like I said, trend following captures that. And so
why do commodities trend? Why should we expect them to trend?
You're God damn it, Chris, you take a long time to get your point. Okay, so yes, so this is look. behaviorally speaking, you can say lots of reasons why people trend. And again, a lot of the synchronicity or like a flow of information, I want to do what other people are doing. There's a lot of arguments you can make for trend following. But I think there's one, and this is like when I first, and I think like man, the economists just get this wrong, and they get it wrong so badly. And you hear this all the time, and you kind of go like, because like they'll look at this world in a deterministic sense. They look at it and they say like, what's our supply? What's our demand? We have this much crude. We have this much demand for crude. The price should be here. Here's the market clearing price. It should be this. And anything other than that is like speculators causing volatility. You're like, that's maybe, but like the thing is like when I would say once again, coming from cross discipline, when I first started, and I did actuarial science, and so one of the courses I took was operational research, and they had this like I thought it was a really cool course on the theory behind how lines are formed, right? It's called queuing theory, and so like there's some takeaways like it's more efficient, to have four lines to four. Do you have four lines to four cashiers, or do you have one long line that splits off to the four? It's always better to have one line that splits off to the four because the expectation is the same, but there's way less standard deviation. You could get in the slow line or the fast line and wait longer or wait less, and like same expected return, but less risk. And you're like, yeah, you should always have one queue, and that's kind of like that was a takeaway of queuing theory. But like the one that really kind of struck me was you can model the distribution of risk, and I know that Nassim Taleb, like he talks about this all the time. It's like people always think everything is a normal distribution, and in many cases, and everyone always thinks normal distribution. Like when we're pricing volatility commodities, we think normal distribution. We go like, where can it go? What is the range of possible outcomes? And you go, I don't know, 20% vol, and I think this. And you go, and it gets it completely wrong, and it gets it completely wrong because it misses like a very, very important dynamic in the market, which is, if you think about a cashier, this is like a one queue, one line up, and a cashier can handle one person a minute. That's great. Like one person shows up every minute, and it takes me a minute to deal with them, and I'll never have a line. So people show up every minute, and I take a minute to burn through them, and I never have a line. And that's true. So like you call it like equilibrium, no line. And so you call it the clearing price. And if anyone shows up it takes longer than a minute to show up, there'll never be a line. If they show up anything less than a minute, the line will go infinitely long. But you say like there's a clearing price, and now you go, okay, let's say we clear. Let's say we go like we can handle one person per minute, and one person per minute shows up, and now you can say like let's say we introduce a little bit of stochastic nature to this, a little bit of like randomness to the arrival price. So it's still on average one person per minute, but let's see how that changes the system. And the answer is it completely changes the distribution of how long you should expect to wait in a line, because what you find out is like okay, so you show up and maybe like someone shows up, and then a minute and a half later someone shows up, and a minute and a half later someone shows up, no line still. And then suddenly someone shows up, and 30 seconds later someone shows, and 30 seconds later someone shows. And now the second person's waiting 30 seconds, the next person's waiting a minute and a half, and if someone else shows, because it only burns down at one person per minute. And so this line, it builds up quickly and it burns down. And so every now and then it gets really, really fat-tailed. And then it burns down and then it sits empty. And most of the time it's empty. And this is a system that completely clears, but suddenly it's got a line like 10% of the time. And sometimes that line gets quite long. And they go, okay, let's introduce another source of stochastic noise. The cashier. On average takes a minute, but sometimes takes 30 seconds, sometimes it takes a minute and a half. And right, so you model this whole thing with Poisson distributions, with exponential windows for arrival times, and you model it all, and there's a distribution that gets created, because now sometimes people show up, like 3 people show up in a minute, and sometimes it takes 3 minutes to do someone, and suddenly this line can get really, really long. And that's like a system that clears. It clears perfectly, supply and demand match, but at the end of the day, just through some randomness of supply and demand, noise, you get these incredibly long lines. And so clearly the analogy to commodities is you never get a line, you get a price. You get like, how much do I have to pay? And if I really need this thing, how much am I going to pay to get there? And you'll see that like most of the time it clears. And sometimes it's empty and the price gets very, very low. And occasionally it goes way further than you think it does because it's not normal. There's nothing normal about that distribution. It's a very, very, very fat-tailed distribution. And so you go like, why did the price of sugar go from 2 to 20 and then back to 2? And it's like, well, it's because there's a stochastic noise to this thing, and there's no way to introduce new cues quickly, right? And so if you could introduce as many cues as you need to and take them away as quickly as possible, then there'd be no problem. But the fact is, like, there's a stickiness. It takes a while to build a new mine or to grow a new field, and sometimes there's nothing you can do about it. And at the same time, like all the vagaries of demand side, where it's like if the price of this gets cheaper, I'm going to move over here, and so at the end of the day, the main takeaway is commodities kind of have to trend. They have to occasionally. Because the underlying process is so completely nonlinear.
Yeah, the markets can be can clear, can be efficient long term while also creating these non-normal distributions that allow for trend following or many other phenomena, I imagine.
Yeah. And queuing theory goes into operations research, which is like, now you've got 5 machines. This queue goes into this queue, goes into this queue, goes into this queue. And how do you make that thing efficient? And it gets very, very, and of course, supply chain is that. It's not one into one into one. It's a whole series of these things. And you realize that it can be right, and it can be right most of the time. And it's a very fragile system, and occasionally goes off a little bit because of like randomness. And then you can get these really, really big price moves because people need that thing. And if you need that thing, you'll wait a long time in line, or you'll pay a high price for it. And so so from that, and the thing is, like, the key features, it's only commodities that have that effect as far as I can tell, because everything else, you can perfectly fungibly trade the future for today. I can trade a future S&P for today S&P, and the only difference is the risk-free rate. I can infinitely create new queues. Whereas commodities, like, I literally, if I need it right now, there's nothing else I can do but to pay up for it. So I think it's a very particular commodity-specific dynamic. And so I'd say, if there's going to be one thing, I would trend follow commodities. But the problem is, as a CIO, is that there's not that much liquidity in commodities. There's only so much. There's 5 or 6 that have enough liquidity, but I would say of like the 20, 25 like most liquid commodities, if you're like a $200 billion pension plan, there's just not enough for you. They're literally like. That's right. You're out of luck. You're out of luck. Mm-hmm. You cannot hedge your commodity risk, and so you come at it different ways. You come at it with natural resources, infrastructure that might have some, like peripheral exposure. You might try and buy mining stocks, but they got that equity risk. And it's like clean commodity exposure is very hard to come by if you're a big plan. This is one of those. This is one of those areas. And I always talk about this when you're a smaller pension plan, if you're a smaller institution, if you're high net worth, you have a very, very significant advantage over the big plans. And you don't have many advantages over the big plans, but this is absolutely one of them, where there's a bunch of things that you can do that they can't. And like I said, in life, always take advantage of your competitive advantages.
And yet everybody wants to mimic the big plans, right? Oh, I want to run my portfolio like the big pension plans. Why? Why would you do that? They're full of constraints.
That's why we ran our masterclass and specifically targeted solutions for those with less than $10 billion to allocate. Yep. Because once you get above that level, you are so limited in the solutions that you can bring to bear that there's not really a lot of differentiation that you can bring to the table.
In liquid capital markets, it's very hard to suck enough money out of liquid capital markets to feed a $200 billion machine. That being said, and this is why you can see like these big plans going towards privates, like there's massive capacity. I'm still struggling with the buy high, sell higher markup. Is that alpha or not? Question. That thing that you bought 5 years ago and the cash flows haven't changed and you're just paying more for it. Yes, you've made money. You got there early and someone else was willing to pay more for you than the same thing. And but if you went and bought another thing at that new price, I don't think you're ahead necessarily. But if you can sell and get out of the market, but the question is like, do you exit completely and try and come back in later?
No, it's like owning a home in a certain market, right? Your family's there, your friends are there. The home price goes up in value. You think you're wealthier, but you're not really, unless you're going to move to someplace that's substantially cheaper, right?
Yeah, but in this world, like this, and like, look, not to get back to the moral hazard trade, but like this is the problem with the Fed doing what they're doing, with the discount rate, what they're doing, with inflation doing what it's doing, is that it's completely disproportional. It's uneven. Because yes, you don't feel any wealthier because you're not. You've got the same house you had, but the person entering the market is screwed because like they literally, and that's where you go. And this is where the Reddit army, Bitcoin. I know you guys love Bitcoin, so I'm not going to get too deep in this one. But like, I feel these are intergenerational wealth transfers trying to bring money back, and I think they should, because at a certain extent, like the boomers have made this.
Well, it's a Hail Mary.
Very unfair for most investors. But anyway, that's an aside.
Anyone else want to go anywhere else? We're 10 minutes past 2 hours, and I know
we need to have the Schindler part 2.
In conclusion, what you're saying is I should try and follow the most illiquid crypto. That's my takeaway. That's where I'm going with this.
Crypto is a perfect market that shows this, right? You have
not advice.
Not advice. No, but just generally from a structural barriers to entry perspective, there is a lot more opportunity for alpha in crypto in low AUM amounts than you do have in liquid markets at traditional.
Sure. I mean, the only thing I would say about crypto is it's just very, very, very high volatility. You could also probably go after 100% fall in crude. But
you can't. But the leverage issue comes in there, right? Like nobody's going to give you that much leverage.
But then you should also be very, very careful with that amount of leverage. Is my only point. Right. But crypto not my thing. And not my thing is not like I'm negative, just more like I don't know it. And
There's a great question in the chat here for you, Chris. Book recommendations.
Oh, interesting. So I'm going to circle back on. Like, I haven't read a good investing book in probably 2 or 3 years. Like I said, I love that Michael Lewis. I only think about the 10 or so books that I really loved, and I'll send that out. I've been reading
we'll send you Corey's book later.
I've been reading sci-fi recently because I love this what if question of sci-fi as opposed to what was through someone else's lens. I'm a big I
you and me both, brother. What are you reading?
The Neil Stephenson, Adrian, the Dan Simmons, Adrian, N.K. Jemisin, the fifth season. I thought that stuff was great. I had a 3-body problem. I kind of like
That's right. We finally found somebody that loves the 3-body problem.
I don't so I didn't love it, but I read it. I said I thought it interesting.
Well, we're gonna delete that later.
but I thought it was very interesting. But and if I said podcasts I love listening to, I would recommend to anyone to listen to Dan Carlin's Hardcore History. I think that is the most phenomenal podcast. And I think the coolest thing about that is humans are humans are humans are humans are humans. If we're talking about behavioral psychology, we're talking about culture and the implications of culture and how you act. It's the crazy thing is no matter 2,000 years ago or 1,000 years ago or 3,000 years ago, it's humans are humans, but the culture dictates so much of the actions to such incredible consequences. And it's just really interesting to see to see how people react and move in the culture that's created for them at that time, and the crazy implications of what did it really mean for the first voting states in Greece to one of when Athens first voted against to go to war with the Persians. It's oh my God, they were that was the worst decision ever. And it happened to work out because of a couple of things that saved them, but the Persians would have absolutely murdered them, and it was just one of those well, we're a democracy and why not let's take a fling on this. And you realize that Julius Caesar a lot of his campaign was because he was an in debt. I don't know and needed to go the resource at the time was slaves, but he was it's the motivations and the factors in the story. I think he's extraordinary. So anyway, just to say
that's all right. That's great.
Yeah, but I'm not I have to be honest. I am so buried in finance, full time, day to day, and I haven't found the book that maybe I should write it. I don't know. That explains my thought processes cleanly. Anti Element's book on expected returns is obviously I think absolutely worth reading. But there's 10,000 books on portfolio construction. They're probably all quite good, but I think they're all missing the most important point, which is how much risk to take. And we'll get into that in a different podcast because this is a long and important discussion.
All right. Well, let's tie a couple of close a couple of loops. So you got 21 strategies. How do you allocate to them? Is 121 and 121st in each, or how do you think about it?
Mostly. So I would say we start with that because look, if something backtests they all backtest about as good as a CTA, a sharper one roughly or a bit better. But then you take into account if there's any kind of big turnover differences. If there's any breadth differences, most of them play all the assets. What happens if one of them is commodity only, and you take that into consideration. I think I would say ultimately turnover and breadth are the two that kind of make you pull back on some that aren't as good. A couple of them correlate with each other at a 0.2 or 0.3, which bugs me because anything above that, I'll say it's just one thing. Throw them together. 2 or 3 0.2s. This is this is once again the correlation thing. It's how many 0.2s before they're not independent, and you've actually got the answer is it's a 0.3, and suddenly 3 become 2. But at the end of the day, there's a couple, and the bigger challenge is not the signals themselves. You can run independently, but they're not independent things. They're not hey, here's 20 managers doing their own thing. What they are is 20 sets of inputs into what do I want to do with the S&P today. Right, and so so at any given point in time, your signal in the S&P is absolutely continuous. It's rising and it's falling as these things are saying I want more or less, and they're voting. And then you've got other things coming into account, which is your vol targeting, your beta neutralization, all of those pieces, all the different betas that you have in there, are also adjusting your S&P. So all that's working together. When you say with these guys, if you let them run as independents, the real risk is that even if they're on average independent, every now and then 3 or 4 of them will be all leaning the same way, or 6 or 7 leaning the same way. And suddenly you go at my portfolio level, I want 20 independent bets. I don't want one concentrated short bond bet or long equity bet or short trend following bet, because that I want 20 independent things, not one thing. And so the key, and I think the secret sauce and probably the most important feature is how do I respond to that without destroying the alpha signal, which is like when you want more of that thing, you want more of that thing. But at what point does it become too much of that thing, and you have to start pulling back on it because it becomes a contagion? Like there's a cancer, and you want to kill it out. And so the portfolio construction and risk and beta neutralization is everything, I would say. Or it's so much of it.
You're beta neutralizing risk parity, beta, and trend following beta, right?
I'm sorry, I just got a comment for somebody. I am beta neutralizing naturally by signal generation. You do your absolute best to make the thing beta neutral when you generate. Like so you say when you build a model, you want to make sure that the signals themselves on average are zero. Like so, it's like my equity on average is zero, my bonds on average, and every single asset on average is zero. But even then, that doesn't get you beta neutral necessarily, because you might be long in high vol and short and lower vol regimes. Like you might end up with some residual beta, but you do your best at the signal generation piece, and you do their best at for all the betas at the signal generation piece. And then you look at all of those guys together, and you go, now what is my residual beta that's left over? Because there's always some beta left over. Like when we were doing equity quant at Teachers, we built like to the best of our ability beta neutral quant. You go, how do you do it? It's like, well, if I have a Canadian quant factor, I would beta neutralize to the Canadian market, right? Okay, that's alpha. It's uncorrelated to the Canadian market. But if I check that alpha and check its correlation to other markets, I would 40% correlate to the S&P 500 and 20% correlated to the FTSE. It's like, well, why? Because the Canadian market is itself completely concentrated in idiosyncratic thing. And so you go, I got to beta neutralize to everything. And then you go and the same thing if I beta neutralize S&P 500 to S&P 500, I still might have some correlation to and so betas they stick around. And so you've got to you handle them where you can, and then you look at the entire system and you handle them again. And then you can handle them in lots of different ways, right? You can handle them, backwards looking or forwards looking, and different levels of responsiveness. And a lot of that has to do with am I leaning against the signal, or am I trying to demean a long thing, or am I trying to lean against when it gets too big? And like I said, there's some art and science to it all. But at the end of the day, the real goal is to try and be as uncorrelated as possible to everything, while still, Corey, having your positive returns, obviously, because without the positive returns, I would say the lack of correlation is less than useful. So.
And then finally, do you have any expectation that your strategies are going to run their course, right? That there's either crowding or some other phenomenon is going to drive the expected alpha to zero at some point?
I mean, absolutely. And I think there's two bits to this. The first one is, I think the themes may still persist for quite a while, because I think there's always, like I said, it's the same thing. These guys are here, but the question is how to capture them. Do you have to get faster? Do you have to get more reactive? Do you have to be more on top of the beta change? And the answer is yes. Because even if those ideas are there, the market is constantly changing. And so even if the idea can still be captured, the parameterization to do it has to be adaptive and dynamic. And so we have a bunch of models which are constantly trying to find, not one sample look back, what would it have been, but how do I constantly try and figure out what it should be right now? This is why I'm so excited to do this. I love when someone builds a house and you go they can look at I tangibly built a thing. That's the pleasure of physically building something. I get that pleasure out of building a new model or building I love researching and discovering. I love the process. Yes, I'd love to keep going on this. You're constantly trying to push to the right side of the curve and add new things.
Then I think we should take Jason Buck's advice earlier on that we should just call ourselves discretionary alpha managers. This is exactly what we're doing. Why are we dealing with this quant systematic BS? Let's just say we're discretionary managers trying to constantly find alpha. Maybe we'll be taken seriously then.
Yeah, I mean, like I said, the challenge we have is that it's so replicatable. Someone leaves with your code, then someone else can do it, and someone else can do it, and someone else can do it, and suddenly, and then alpha disappears. And alpha disappears really fast. Every good idea.
But how is that? Isn't that the same thing as a discretionary manager? Once he kind of gives away his model, it's the same thing.
No.
Think about tiger funds, the baby cubs or the cub tiger, whatever they're called.
They were systematic. Like if you're a discretionary manager and I say, here's the trade I'm doing. I'm buying bonds and selling China. What am I doing next month? Good luck. Like you have no idea what I'm doing. That's the beauty. I can tell you the entire trade, the entire thought process, and you get one for free. It's like.
I think that's true if it's an open enough universe for a discretionary manager. But when you I mean, the number of discretionary equity managers I look at that have an identical funnel, right? It's that upside down triangle that goes, here's our universe, and then we're going to screen on quality and screen on profitability and valuation, and then we end up with our portfolio. And by the way, they have to do that because all the allocators are trying to put them in a very defined box from a risk perspective. So they end up, I mean, again, that's why you can explain so many managers with these primary characteristics, and very few of them actually deliver any alpha at the end of the day. You've got these agency problems, and
yeah. So I don't disagree at all. I mean, like someone's going to argue, someone smarter than me is going to argue that like everything is a risk premium. There's no such thing as alpha. If anything persistently makes money, like they're probably they're either like systematically capturing or discretionarily heuristically capturing something persistent. Maybe not, but like you can there is a discretionary point to what we're doing, because every single decision that we make is a discretionary decision that just happens to be made ahead of time. Like every single thing we do is a discretionary, which is why you're investing in the person. You're not like you have, because you have to buy into the thought process, the intelligence, the creativity, the integrity, because and the integrity is like it's so easy to cheat yourself in this space, and everyone does it a bit. There's no way not to a little bit. But the question is like, am I cheating myself? You got to be very, very careful with that. Eyes wide open. What am I like? How am I trying to build the best thing possible? And how do I defend myself against that? Is the first question. The second question is, am I cheating you? Which is like, I can't, like, one of the things that we had the pleasure of doing over and over again was getting dealer products produced to us, and we were probably the only team in the world that would go like, oh, you're pitching a trade to us. Let's just check it. Let's build it ourselves. And I've already told this story, so I'll give like the quick version. But
maybe to me privately, I can't remember anymore.
Yeah. Okay. So we would reverse, like when a dealer said like, hey, here's a process, we would test it. And the thing is, like, they were like, and the dealers have gotten better with their product, I think, over time, but like they were never that good, because the problem is you have this agent management mismatch, right? Which is the and especially the challenge was early on is where like when you're selling a swap that has no performance fee and just management fee, like obviously all you care about is selling as much of it as possible, not necessarily how well it does. And if it doesn't do badly, if it does really terribly, you can like roll it around, start a new one, and you know your sales team will sell that one. And so and so why performance fee is so important is because you've got to eat your cooking in some way. And like we like, I remember one in particular, and this is one of Rodrigo's probably we had a sharp ratio of 2 presented to us, and we went, oh, we're gonna like test it. What assets? And then the second we said we're going to test it, they came back the next day and said, yeah, it's only like a 1.2. Like literally, they walked back from a 2 to a 1.2. Like the second we said we're going to test it, and they went, oh, okay, that's cool. Either way, like what assets did you use? And they went, we use this and this and this, and we went, huh. Like it was a currency thing, and it's like, well, like why didn't you use the yen? And it's like why didn't you use those ones? They said, oh, they're the most liquid. And it's like, I don't know, you got Canada in there and you don't have the yen. Like that seems weird that you're missing. So of course we tested on all 14 currency pairs that we had, and at the end of the day, went. They chose the 8 that worked and got rid of the 6 that didn't, because like they're trying to create a back test, and like so the 1.2 came down to a 0.6, and then we went, okay, so and what parameters did you use and what time, and you just start to like literally this thing that was presented us too. I think when we first went, like we think like it's legitimate like a 0.4, but then we went, okay, there was actually a bit of an idea in there at a 0.4, and then we kind of went like, how can we like turn it into something else? But like it was a the fact is there's a lot of decisions that you can make that you wouldn't have known to make at the time. And those can artificially inflate your back test, and they can result in a worse process going forward. And so like you have to make sure that there's a proper alignment to make sure, to reduce the probability of that.
I will just add, because you mentioned that to be successful at making money in asset management, you either have to be first, you have to be smart, or you can cheat. And I think that's exactly what in the movie Margin Call, the character goes on and says before he decides to be first, right? You can be first, you can be smart, or you can cheat. And I think a lot of these major banks are cheating knowingly. Not always, but you can see it.
I think they've gotten
and make a lot of money doing it.
I think they've gotten better. I think like offline, I'll tell you a story about like the East German, like, so I rode with I rode a lot when I was younger, and we had like the East German national team over and coached the Canadian team, and they brought over what was it? That time it was a brand new technology of like training, like how to train better, and literally like it was. I made gains in my performance that were unbelievable by just changing the way that I trained. but it took 2 years, and it was huge pushback against it. And I'd say that's a mixture of smarts and technology. And like once again, the alpha of that disappears over time because and it turns out Canada was just behind East Germany. Now, when you talk about like technology and smarts, of course they were also cheating because like he didn't bring his drugs over with him. But like at the end of the day, so we were certainly behind on because we didn't have a drug program. But like and then that alpha. This is like in sports, it's exactly the same thing that happens. Is like and like that alpha disappears over time as well because because that technology starts to spread out, and then all it does is just raise the playing field. And that advantage you had, which is I could train better than anyone. Like I mean, like I still like I raced at the World Duathlon Championships 2 years ago, and like it was 3 years ago now. I don't even know. I think time goes by, but I because I had this like technological advantage. I knew how to train better, I think, than almost anyone, and so. But like bit by bit, it's like I would tell all my friends, like, oh my God, you're training wrong. You can do this. And they all got like 10% faster. And then all that happens is like, well, now everyone's just faster. And that advantage disappears. And of course, like over time, as advantages disappear, like the skill reduces and it becomes more and more of a luck question. And we can talk about, that's a totally separate topic. But but that is technology, intelligence, dedication, and then like what Canada didn't have at the time. I'm going to guess like still is the Masters World.
Oh, fuck. Okay.
Different.
Sorry. Like, that's some good tech.
World Championships. Like Masters. Sorry. So
all right.
So I raced in it.
I was going to go back and shoot myself in the face.
Came second. Was super excited. Was gonna train. Like I was like when I first left teachers, like, well, I got this year off. Or I have to take a year off. I was like, I'm going to train for this thing. I'm going to go win it next year. And then so the race was in Denmark in June. And like in September, I got an email going like, hey, Chris, the guy who won your race failed his drug test. He's being disqualified, and you're now the world champion. And I went like I ignored it because I thought it was like a bullshit letter. He goes, send us your medal. We'll send you like and so I ignored it. And 2 weeks later, like, hey, just so you know, it was exactly they had like a 2-page spread on him and like it was DNF. And he was disqualified. And so then I was like world champion. I was like, okay, I never want to do this again. So I'm done. So that was
good for you. That was awesome. That's amazing.
That's why.
You probably missed some good sponsorship opportunities.
Well, now I'm like 25 pounds heavier and starting a hedge fund.
In muscle?
No.
You've reverse engineered the weight training program.
There's no weight training.
I wonder, would have there been any sort of like accolades or sponsorship available to you for having won that if you were at the time number one? Because I know that's a big issue with Olympians.
Masters duathlon.
I don't know.
The key in this world is to find an obscure sport and race the other 45-year-olds. So short answer, I don't think so. Long answer, I would be happy to sponsor people in this sport. Like there's the young kids who are getting out there trying to get going. Like the last thing I need is sponsorship. Like it's like you got to go find the kid who's like 16 and get up and running.
It's just a big issue. A big issue with the Olympians are those that come in second, and then like a year later they say, "Well, we found that this guy was doped up, so you get the medal." But all the sponsorship and all the accolades, all the travel around the world, all the things, that life path is gone. So you could have been a famous duathlete.
Turns out there wasn't
Little
any.
do you know.
This is like it's like look, it was one of those things. Did it, liked it. Probably never want to do it again. Moved on to the next challenge. I don't like anyway, except for bragging 2 years later on a podcast.
Speaks to your character. Speaks to your character. Good job, man.
Should we release poor Corey here? He's been a gracious co-host. We've been holding him hostage.
This has been fantastic. I got to tell you, I was super excited for this one. I don't know how I wormed my way into co-host, but I'm very happy to be here.
Oh, I love it. I go 2.5 hours. You guys, I cannot believe there's anyone still watching, but I feel very sad if they are. But best of luck on your Friday night.
That's all good. They'll listen to it later 5 times, as it tends to happen. Yeah. Awesome.
Great.
Chris, Corey, thank you so much for joining us. This was absolutely all that we expected. So have a great weekend.
Fantastic. And I think I told all my stories, so it's like
no chance. You wish.
All
right. Well, good having you guys on. Thanks, Corey. Thanks, Chris.
Have
an awesome weekend.
Yeah, follow. By the way, guys, if you enjoy
no
this
investment
content.
advice.
No investment advice.
All
right.
Guys,
Cue music.
See you guys.
Today's podcast is brought to you by Horizon's Resolve Adaptive Asset Allocation ETF. which trades on the Toronto Stock Exchange under the ticker symbol HRAA and is sub-advised by Resolve Asset Management. HRAA is an alternative fund whose investment objective is to seek long-term capital appreciation by investing, directly or indirectly, in major global asset classes, including, but not limited to, equity indices, fixed income indices, interest rates, commodities, and currencies. HRAA gains exposure to these asset classes by investing in derivative instruments that may include future contracts and forward agreements and securities. HRAA will take long or short positions, using up to a maximum of 3 times leverage in asset classes such as equity indices and fixed income asset classes, commodities, currencies, volatility indices, and other alternative asset classes. To learn more about this, please visit www.horizonsetfs.com/HRAA to read about the ETF's investment objectives and important disclaimers about the risks associated with an investment in the ETF.